start.
Yeah, good evening, all of you. You are welcome to this second day of the refresher course, 360 degrees on annual report. Today, we will be joined by our speaker, CA GN Ramaswamy sir. Let's start the VCM with motto song. You need not stand, but you can place your hand on your heart. Give me a second to share the screen.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैत 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 एतद्द्वैत.
Yes, over to the chairperson, madam, for her opening remarks for this second session.
Thank you, sir. Respected Central Council Member, Program Director C.S. Selva, Preeti Paras in absentia. Madam is going to join in any time. And speakers of the today's technical session, C.A. GN Ramaswamy and colleagues of Managing Committee and past chairman of the branch and coordinator of this program, C.A. Gadavati Srinivasarao, and my dear fellow members, good evening to one another. And my hearty welcome to you all for the second day of 5 days virtual refresher course on 360 degrees of annual report organized by Corporate Laws and Corporate Governance Committee of ICAI, hosted by Vijayawada branch. Members, hope yesterday you had excellent sessions from our expert speakers, C.A. Jaman K. George sir and C.A. Subramanya Sarma sir. Your interaction in the chat box really itself it is evidential for your active participation in the sessions. And our today's topic is understanding of deferred tax liability, cash flow statement, and MAT computation. As you all know, deferred tax liability is a listing on a company's balance sheet that records taxes that are owed but are not due to be paid until a future date. The liability is deferred due to the difference in timing between when the tax was accrued and when it is due to be paid. In the same way, the objective of introduction of MAT is also to bring the tax net zero tax companies, which instead of having earned substantial book profits and having paid handsome dividends, but they don't pay any tax due to various tax concessions and incentives provided in the income tax law. Likewise, cash flow statement. Even though we know the concepts, but we will get so many doubts what to include and what not to include while doing the computations. Our today's expert speaker, GN Ramaswamy sir, is with us to clear all your doubts. Thank you, one and all. Please enrich, have participation and enrich yourself with the session. Thank you.
Yeah, thank you, madam. A quick word from our past chairman, CA GSR, with regard to the concept with which these programs have been formulated by him. What do you say?
Sir, good evening, sir. Welcome to GN Ramaswamy, sir, today's resource person. Friends, as you all know that this concept of 360 degrees of annual report has been devised only to have a very good interaction with that young budding chartered accountants who would like to, because there are very meager practice in the corporate law. Thus, they are not able to concentrate more time on the FIs of the Companies Act, particularly deferred tax liability and what to add and what to deduct, and all these things will have a hectic affairs, because once you know the things means it will be easy for you. But unless you learn the same, it will be a Greek and Latin. The same is the case with the cash flow statement and other things also. So I request each and every person who are attended here to make use of this facility. Definitely it will help you out in your discharging your compliance schedules. Thank you, and over to you, sir.
Thank you, sir. Thank you, sir. I request CA Jayant Uppuluru, Chairman of Sikasa Vijayawada branch, to say a few words about today's speaker. Over to you, Jayant garu.
Yeah, thank you very much, sir. It's my privilege to introduce Ramaswamy sir. So, sir is a fellow member of Institute of Chartered Accountants of India, and is also a information system auditor, and completed his post-qualification certificate courses on IFRS and international taxation. He is a registered insolvency professional, having enrolled with the Insolvency and Bankruptcy Board of India. He is also a registered valuer for securities or financial assets with IBBI. He is empaneled as an independent director in the data bank maintained by IICA. He possesses more than 28 years of post-qualification experience in servicing large and medium-sized clients in the areas of statutory audit, encompass applications of financial reporting standards, apart from advising clients on strategies of governance, reconstruction, restructuring, acquisitions, and related valuations and tax implications. Sir also possesses wide experience in listed companies and other entities in private and public sector across bank and financial sectors, manufacturing, trading, plantations, consumer products, logistics, hospitality, healthcare, and media. He is also a fellow member of Institute of Chartered Accountants of India and an executive committee member and secretary of Society of Auditors. Sir has presented many papers in various seminars and study circle meetings organized by ICAI, ICSI, and SOA. Along with, he has hobbies of travel and reading. He is also a passionate photographer and currently the secretary of Photographic Society of Madras, one of the oldest photographic clubs in the world. Thank you, sir. Thanks for this opportunity.
Thank you. Thank you, Jayant.
Over to you, sir.
Thank you.
The screen is visible?
Yes, sir.
Perfect, sir. You can magnify the screen. Yeah, thank you, sir.
Thank you for the opportunity. I thank Vijayawada branch, the chairman and office bearers for providing me an opportunity to present a paper on two topics. Actually, I've been told to take only this cash flow statement. Subsequently, I think I've been added with other standard also. I have no issues. I will cover both. I've been told that the audience are mostly the young chartered ones who have started the practice in the recent years. They want to have an in-depth knowledge on the basics of these two standards and also the MAC credit. So I will be touching upon the basics. Any questions at any point of time, you can put in the chat box. We can discuss at the end of the presentation. And if I'm not sure whether I can cover all the queries, I can clarify all the queries across the table because due to the paucity of time, because we have to complete by 8 o'clock. You can send a mail to the Vijayawada Institute. The chairman or office bearers can collate their queries and send to me so that I can answer those queries one and all, so that it will be easy for better understanding. So hope I am clear. And I will just move on to AS3. So though the topic has been given first to start with taxes, I thought cash flow I can cover first. Then I can cover both the topics, taxes on income as well as MAC credit. Together it will be easy to have a better grip. I hope I'm fine with this. Can I proceed this way?
Great, sir. Go ahead, sir.
Yeah, thank you. So AS3 is a cash flow statement. It is one of the oldest standard. In fact, every balance sheet, what you see, you will have a balance sheet P&L. In addition to that, there will be definitely a cash flow statement. Previously, it was optional for some of the entities that we'll look into in detail. So what is the objective of this statement? The cash flow statement is useful for the users to assess the ability of the enterprise to generate cash and cash equivalents. So unless the company or entity is unable to generate cash, it will be difficult for surviving the market. If everything is accumulated in inventory or trade receivables, the company can't function. They have to liquidate the assets, generate cash, and again pump in for purchase of material. They have to rotate the thing. That is the more important thing. So the cash inflow statement is one of the major items where we can see how the cash is flowing into the entity and how it goes out, how it is being replenished by way of investments or other borrowings, whatever may be. So this is the one of the most important statements where the user can check the ability of the enterprise to generate cash and cash equivalents, and also how it is being utilized. This is the main purpose of this cash flow statement. What is the scope? So an enterprise has to prepare a cash flow statement and should present it for each period for which the financial statements are prepared. So whenever you are preparing a balance sheet, a cash flow statement is a must, and it has to be presented with the corresponding previous year figure. Whether it is mandatory for all, I will say literally yes, because Companies Act section 240 defines the financial statements, says it includes a balance sheet, a profit and loss account, a cash flow statement, a statement of change in equity that is applicable only for India's companies, not for all other entities. Explain note that is regular notes and other details, whatever you are giving in the accounts. But previously, Companies Act was not defining the cash flow as a mandatory requirement. Now, section 240 mandates that it is a mandatory item as far as financial statement is concerned. However, it excludes some of the entities, namely one-person company, small company, and dormant company may not include the cash flow statement. They say they are not saying that shall not include. They say it's only optional. So if the company has an option, if they want to prepare, they can provide. But if they provide a cash flow statement, they must compulsorily comply with the requirement of the standard. They can't deviate from this. So these three entities, they have an option whether to present a cash flow or not to present. If they decide to present, they have to comply the standard. All other entities are mandatorily required to give a cash flow statement. Recently, the accounting standard rules have been notified 2021, wherein they have given some exception to some of these, but as far as cash flow is concerned, except these three, there are no other changes. What are the benefits of cash flow? So the users can understand how the cash is coming into the entity, how it is going out, whether the company is in a position to meet its liquidity on a timely basis, all these things. So based on the historical flow of the cash flow, the user can decide how certain the company can generate cash, how it can use it for its business requirements. So this is one of the main benefits, so that the future past cash flows can be used as a benchmark to check the future cash flows and to project the profitability, and also to check what is the future cash flow to decide on the value of the company. This is the main benefit of this cash flow statement. Let us look into the definitions. Everybody will be aware of this, but I'll touch upon the key definition because this is more important whenever we are going to the next few slides. This understanding of these definitions is more important because certain things will be in the back of my mind, but we will not be using it on a day-to-day basis. Cash, we will think that cash includes only liquid cash. No, it includes demand deposits with banks. So as far as the standard is concerned, cash includes cash on hand and demand deposits with banks. That is why if you see any short-term deposits, the deposits which are repayable on demand has to be treated only as a cash, not as a bank balance. Cash equivalents, in addition to cash, short-term, highly liquid investments that are readily convertible, which are not having a significant risk of change in value. So these are all cash equivalents. So cash and cash equivalents is the one area. Cash, you maybe have a schedule 3 gives when we are giving the cash and cash balances, we will say cash on hand, then we will say cash with a original maturity of less than 3 months, 3 months to 12 months, more than 12 months. So more than 12 months, always you will put under non-current or other thing. But when you come to this short term, we will take only 3 months is the highly liquid. That is why we are using the word short term. Cash flows are inflows and outflows of cash and cash equivalents. It will be either way, inflow as well as outflow. Operating activities is a principal revenue producing activities of the enterprise. If a company is in manufacturing, the income from operation or sale of manufactured goods, it is the operating activity. Investing activity, we have surplus, we are putting in investment, say in shares or mutual funds, or we are giving to some other entity. So those things are investment. The company is transferring its surplus asset into another entity or other concern is an investing activity. It can invest in plant and machinery, it can put a new plant. So that is an investing activity, of which they will generate operating income, but this is an investing activity. Finance activity is nothing but amount what is coming into the company for running the business, either from the owners or from the lenders. It can be from banks or from debenture holders, what it may be, any borrowings into the company. So you split your balance sheet and P&L into three things. Balance sheet, one is the equity, liabilities side, bonus amount, as well as the borrowing from banks and outsiders is the financing equity. Whatever the asset side the company is giving to others or investing in others or lending to others will be investing activity, and whatever income is generated, that will be operating activity from your operations. So this is the broad understanding. We'll look into all these things in detail in the subsequent slides. Hope my speed is okay, or can someone type whether it's fine or I need to slow down? Fine, yeah. Cash equivalents are held for the purpose of meeting short-term cash commitments rather than for investment or other purposes. So you'll be putting in mutual fund. That may be for some long-term objective of the company, but cash, we are putting in the term deposits or demand deposit just to meet the short-term requirements. Instead of making the payment to the creditor, if it's due on 30th day, we'll be parking that balance in 15 days or 20 days so that it will earn some interest. That is nothing but a cash equivalent. So for an investment to qualify a cash equivalent, it must be readily convertible. So normally investment is outside of the cash and cash equivalents, but there are certain exemptions. Suppose you are going to purchase an investment very close to the maturity date, then you can say it as a cash equivalent. Normally shares are always excluded because the value cannot be decided upfront. Because the cash, if you say cash and cash equivalent, you must realize the amount what is stated in the balance sheet. But shares, definitely there will be some variance because it will fluctuate in the market or certain things. It can't be transferred easily if it is unlisted, so it will not be treated as cash and cash equivalent. But preference shares.
Sir, I'm very sorry to disturb you, sir.
Pardon, yes, madam?
Can you make your explanation a little bit slower, sir? Some members are expressing that view.
Yeah, sure, definitely.
Okay, thank you.
So shares now, as we say, the shares cannot be sold just like that, and we will realize the amount which is more or less than the amount what is stated in the financial statement. So obviously, it is not a cash equivalent. But preference shares, if you are going to purchase which very close to the date of maturity, and we are sure that amount will be paid in full without any difficulty, then it can be treated as a cash equivalent. That is an exception. Normally, any shares or any investment shares will not be treated as a cash and cash equivalent. So cash flows is the movement between these items. Whenever there is a change between the cash balance of the previous year and this year, that will not be routed through the cash flow statement because that is part for meeting the operation of the company. So it depends on the management policy, how they want to invest the excess in cash and cash equivalent. They will put it in either investment or put in new factory, or they will settle their loans, whatever way they want. Till such time it will be grouped under cash and cash equivalents. How it has been presented. So we have to present the cash flow statement in three heads. One is operating, second is investing, third is financing. As I told you earlier, operating is any income or flow of cash from its main operating business. Investing is whatever is an inflow or outflow from its investing activity, and say is a financing activity. So it has to be decided in a manner which is most appropriate to business. For example, a finance company, financing activity is the main operation. So they will show those lending and collection from the customers as a operation income from operation. But for others, whenever you are lending to some of your sister concern or your subsidiary or associate, that will not come as a operating activity because it is out of your surplus you are going to invest. Then you have to show it as a investing activity, not as an operating activity. So you have to check what is the object of the company. Accordingly, you decide whether a particular inflow or outflow will be fit under operating or investing or financing activity. So that is more important. So a single transaction may have different components. For example, if you are going to purchase a fixed assets on a deferred payment basis, it will have both interest as principal. The principal may be as your investing activity, but your interest will go as a financing activity. So these nomenclatures, the classifications, we need to understand so that it will be a correct presentation in the cash flow statement. Operating activities. As I said earlier, it is the main principal operation of the company, so that the operation of the enterprise have generated sufficient cash flow to maintain the enterprise, to pay dividend, to settle dues, make a payment to the lenders or bankers, and make new investment for the further expansion, all these things. So your primary operation is the main area from where the surplus will be utilized for all these activities. From your profit only, you can make a payment to dividend to your shareholders. You can settle your lenders because you have to pay the term loans on the date. So everything depends on your sufficient cash flow from your operating activities. So this information in the cash flow will help the users to understand whether the company will be in a position to meet the obligations at the respective due dates. What are the operating activities? There's a few examples. This is as per the standard only. I'm not added anything new. So we'll discuss the practical thing when we come to the later slide. Cash receipts from the sale of goods and the rendering of services. If it is a manufacturing company, it will be good. If it is service industry, it is a service income. That is the cash receipt. That is always an operating activity. Cash receipt from royalties, fees, commission, another revenue. We may group it under other income, but this is directly related to the business operations and it is always grouped under income of operation. Then cash payment to suppliers for goods or services. Unless you procure material, you can't produce and sell to the customer. So this is directly related to your operation. So it is operating activity. Cash payments on behalf of employees. They are the main backbone of the company. So without them, the operations cannot be carried on. So obviously it is operating. Cash receipts and payments of an insurance enterprise for premiums, claims, annuities. From an insurance company perspective, these premium collection payments are their operations. Like banks, they will collect money and lend money. That is our operation. Finance company, same thing. So likewise, from the perspective of the entity, we have to see whether that transaction is operating or a financing or investing. Cash payments or refund of income taxes unless they are specifically identified with financing and investing activities is a operating cash flow. For example, any tax paid on the profit for the year is always a operating cash outflow. But in a year, if there is a sale of a land on which there is a huge capital gains, it is not prudent to show that capital gains under direct taxes under operating cash flow, because then your operating cash flow will be negative. So it is appropriate to classify that tax impact under the investing it, so that it will be a better reading for the users. Cash receipts and payments related to future contracts, forward contracts, option contracts, etc., are always held for trading purposes, operating. But it can be different for some of the entities. But normally, if it is held on a trading purposes, then it will be operating activities. Transaction, sale of plant or machinery, fixed assets, etc., there will be a profit or loss that we will be showing under other income or other expenditure, which will be added or deducted when you are preparing the cash flow statement. But the sale proceeds is always a investing activity, not a operating activity. Though it is included in the profit terms for the year, we will be adding it or deducting it while preparing the cash flow statement. I will be coming to that later. But the proceeds, whatever you receive, is always an investing activity, because you already invested. At the time of investment, you would have grouped under investment, purchase of fixed assets or investment in plant and machinery. When we are realizing a part by selling it, then obviously it has to be credited in the same head. An enterprise holds securities and loans for dealing or trading purposes, then it is only operating. Cash advances made by financial company, already we discussed. Any advance given by a finance company for generating revenue by way of interest or otherwise, that is always income from operating activities. Investing activities. So we need to give a separate disclosure of cash flows from investing activities, because it is important to understand the expenditures that have been made for resource intended to generate future income and cash flows. So when a company is putting up a factory, first year, that is the starting point. They will collect share capital from the owners, they will borrow from bank, put up a plant and machinery. So one item will come under as a financing activity, that is inflow of capital, inflow of borrowing. Then that will be deployed in putting up a factory, then that is your investing activity. So that is the main thing, of which you will be generating income for future years by way of income from operations. Few examples: purchase of fixed assets, including intangible. So these payments include in-house research and development, cost for employees' cost for these activities, self-construct fixed assets, everything is always investing. Similarly, cash received for sale of fixed assets, including intangible. So any asset purchased or any asset sold is always an investing activity. Cash payments to acquire shares, warrants, or debt instruments or other enterprise and interest in joint ventures, other than payments for those instruments, considered to be cash equivalents and those held for trading. So whenever you are going to invest in shares or debentures or mutual funds, whatever may be, any surplus amount invested by the company, it is always a investing activity. Any investment in the balance sheet, that increase has to be shown as a investing activity outflow. Similarly, any receipt from disposal of those investment it is a inflow of cash from investing activities. Cash advances loan made to third parties. It can be loan to your sister concern, to your subsidiary or associate or to employee. Everything will come under this head. Similarly, cash receipts from the repayment of advances and loans made to third parties is an inflow from investing activities. Future contracts already covered. If it is nature of other than finance, then it is investment. If it is nature of financing activity, we will be treating that. If it is nature of operation, we will be grouping under operation. These two paras will come in all the three heads. Depends on the nature of the enterprise. We will be classifying it as operating or investing or financing. Financing nothing but any inflow of funds. Either it can be capital or borrowing. Only these two things. Funds are inflow and similarly borrowing, and will be paying interest on the borrowing or dividend to the shareholders. So inflow and outflow of this will be under financing activities. So any cash proceeds from issuing shares or similar instrument, it can be equity share capital, preference share capital, or convertible debentures, convertible preference share, whatever may be, it will be under financing activity. Any repayment of that or any part payment of that or buyback of shares, whatever may be, it will be under financing activity. Cash proceeds from issue of debentures, loans, notes, bonds, etc., or any short-term or long-term borrowing, it will be under financing activities. Cash repayments of amount borrowed. So whatever is the inflow, any outflow out of the same head has to be grouped under the same classification or along with the interest or dividend payment in respect of those things. And we have to factor this, any tax related to that. For example, dividend, if you're going to make a payment, it's always a financing activity. Any dividend tax, now it is abolished, dividend tax paid for this dividend payment also to be grouped under the same head because that is directly linked. It will not go, the dividend tax will not go to the operating head, it will be grouped here. Reporting cash from operating activities. You have two methods to disclose. One is direct method, another is indirect method. Though the standard says direct method is most appropriate method, most of the entities are using indirect method because that is simple to present and it is to give the link from the printed balance sheet. If you have the printed balance sheet of any entity, you can prepare a cash flow on your own without any additional detail. But for direct method, you need to have the access to books of account because it requires very high details to prepare the cash flow statement. So most of the entities prefer to prepare the cash flow under indirect method rather than direct method. But the standard says direct method is better and most appropriate to present a cash flow statement. Under direct method, so we will be preparing the cash receipts and payments from the accounting records of the enterprise by adjusting sales or cost of sales, interest and other income based on the changes during the year of inventories and operating receivables and payables, other non-cash items, and financing and other cash flows. For example, I'll give you one simple example. You have a sales that you can see from the P&L. Trade receivables, there will be a opening balance and closing balance. So sales plus and minus the opening and closing balance is the cash flow from your customers. So that way you prepare in the direct method. But indirect method, we will not proceed from that. We will start from the profit as per profit loss account. We will do adjustment of cash flow items. Then we do the increase or decrease for the respective other item. Indirect method. Indirect method is the net cash flow from operating activities determined by adjusting the net profit or loss. Net profit or loss is the starting point. From that, we will do the changes during the period relating to inventories, trade receivables, and payables, etc. And also non-cash items like depreciation, provision, deferred taxes, unrealized gain, etc. will be adjusted. Any other item for which the cash effects of investing or financing cash flows. So in your P&L or balance sheet, there may be certain items which are related to investing or financing cash flow. Those things will be adjusted. For example, profit on sale of assets. It will be a part of your profit and loss account. You have to adjust that to show that the corresponding amount will be shown correctly under your investing or financing activities. Your interest paid during the year as per the P&L has to be added back so that that can be considered in your financing activity, like that. Dividend now we are not showing under P&L, so there is no issue on that. So like that, we have to analyze each and every line item of your P&L and balance sheet to check whether the line item has to be mapped to your operating or for investing or for financing. Alternatively, the net cash flow from operating activity may be presented under the indirect method by showing the operating revenues and expenses, but most of the people are not doing this. They always start from your profit as per P&L, that is profit before tax as per P&L, and do the adjustments. I will just show you a cash flow statement also, so that we will have a better understanding of how these things are classified. So how to report your investing and financing activities? So always it has to be under gross cash receipts and gross cash payments from investing and financing activities, except there are certain exceptions. What is you make gross? Suppose you are going to make an investment in a plant and machinery, you have to put the amount as a gross purchase of fixed assets, sale of fixed assets. It has to be gross. We can't put a net amount saying that purchase of fixed assets net. We can't put that. You have to show these two things are separately, because these are totally independent. So the user must be in a position to know what is the amount of fixed assets you invested in the year, what is the amount of fixed assets you realize during the year. So that instead of because from profit on sale of assets, we will not be in a position to understand what is the gain or loss on a particular transaction. But from cash flow, we will know what is the value the company generated by selling a particular fixed asset. So this has to be classified on a gross basis and not on net basis, unless there are two exceptions given in the standard, where it can be present on net basis, where cash receipts and payments on behalf of customers, where the cash flows reflect the activities of the customer rather than of the enterprise. So from my perspective, that is not a material to show it as on a gross basis. So better to show on net basis. And wherever there is a turnover is quick, the amount can be shown on net basis rather than gross basis. I will give some examples in this regard. Examples of cash receipts and payments on behalf of customers when the cash flows reflect the activities of the customer rather than those of the enterprise. What are those? The acceptance and repayment demand deposit with bank. So bank will collect the deposits and repay the deposits. It is not prudent to show it on a gross basis. It is always better what is the net increase in the demand deposits and what is the net decrease in deposit. That is sufficient, so that it will have a better readability instead of showing the gross amount, because the volume will be too much. Every day or every 3-4 days there will be a rotation. So it is not prudent to the volume will be so unrealistic. So it is better to show as a net amount. Fund sales for customers by the investment enterprise. So obviously those things will be shown on a net basis. Rent collected on behalf of, that is a very peculiar thing. In India, this may not happen, but if you are going to sublet and you are going to collect and give it to the owner, then we can show it as a net amount instead of showing it as a gross amount. Where the turnover is quick, what it is? Principal amount relating to credit cost customers, purchase and sale of investments, short-term borrowing, example, where the maturity period is less than 3 months, cash credit account. There is no need to say what is the cash credit inflow, what is the cash credit outflow, because the credit in the cash credit account, the debit in cash credit account will be on a daily basis. So it will be voluminous. So there is no meaning into showing what is the total receipt, what is the total outflow. Instead, we can show what is the net increase in the particular year or period, quarterly. Examples of reporting on a net basis. Cash flows arising from each of the following activities of financial enterprise may be reported on a net basis. Cash receipts and payments for acceptance and repayment of deposit, the fixed maturity date. So obviously we'll know the financial enterprise is collecting deposits and it will be repaid on a particular date. On the date of maturity, it will be renewed or it will be settled, and again they will take a fresh deposit. So it is not necessary to evaluate and show what is the gross acceptance and what is the gross repayment. Instead, they can be shown on a net basis. Similarly, placement of deposits. Financial institution will deposit the surplus in another entity or another bank. There also we can go with the net amount. Cash advances to the customers and the repayment of those advances loans. For procurement of material, etc., we'll be making an advance to the customers and the repayment of that. There is no necessity to show the gross amount because that is circled and it is rotated for with a supply of material or of refund. Then it can be shown as a net adjustment. Foreign currency cash flow. As you are aware, any company will have some transaction in foreign currency, either by way of export or by way of procurement of material from other country or travel expenditure, whatever may be. They may have a bank account in foreign currency. So definitely any balance sheet will have an element of foreign currency fluctuation. If there is no exposure to any foreign accounts or foreign transactions, no issue. If it is there anything, obviously you would have seen there is a debit under the head exchange fluctuation in the other expenditure or a credit under the exchange fluctuation other income. So we need to add this as a non-cash transaction because it is only accounting adjustment. But certain things would have been settled. For example, if you are going to sell to overseas customer, on the date of transaction, you will be accounting on a transaction date. That is that date, transaction date, exchange rate. Say it is 70 rupees dollar. Subsequently, after a reporting period is on the 31st March, the value of the dollar is 72. 2 rupees you will be showing as a exchange gain. Subsequent year, the opening balance will be, debtors will be 72. You will be recording 74. So already you recognize the 2 rupees as your exchange gain the previous year. So this year the cash flow is actually 70 minus 74. So 4 rupees the cash flow, of which 2 is the exchange fluctuation difference. So what we are doing is, whenever we are preparing a cash flow statement at the year end, we need to bifurcate this exchange fluctuation account in the P&L into realized exchange fluctuation and unrealized exchange fluctuation. So it has to be aggregated to the respective heads. Either can be trade receivables, trade payables, bank balances, whatever may be, and the unrealized, that is exchange fluctuation accounted in respect of the closing balances. Either can be debtor or creditor or your bank balance. That alone to be segregated. That alone will be added or deducted in your cash flow statement as an adjustment entry. Why? Because this is the only amount which is not realized. All other things have been, suppose for your exchange fluctuation debit as a loss for the year is maybe 10 lakhs, of which 9 lakhs would have been recovered during the reversal, and the balance 1 lakh is the entry you passed while closing the books on 31st of March. So this only 1 lakh will be added to the cash flow profit as profit and loss account. From there, you will be doing the adjustment so that your closing balance will be coming correctly. You will not add the entire 10 lakhs, because of which 9 lakhs have been already settled. So for comparison, this is the explanation I have given to you. So this is unrealized gain or losses from the change in foreign exchange rates are not cash flows. Hence, we have to do a reconciliation separately. Extraordinary items. The balance sheet and P&L may have some extraordinary transaction. For example, the losses on account of fire, earthquake, or what it may be, and some settlement of loans with the banks. As a one-time settlement, they would have given a huge credit. The company would have presented those things as a extraordinary item in the P&L. But while preparing the cash flow, though it is shown as extraordinary item under the P&L, it has to be grouped under the respective head, whether it can be operating, investing, or financing activity as appropriate, and should not be separately disclosed as a separate item as we do in the P&L. So, but we need to give additional disclosure so that users can understand what is the nature of the transaction, how it is being presented. Interest and dividends. It is one of the interesting points because most of the mistakes will happen under this head only. The reason is normally when we prepare the statement, interest received is another income, we will not do any adjustment, that will go as it is. That is not the way. We have to understand what is the from whom we receive the interest and whom we receive the dividend. If it is the dividend received on your investment, obviously it has to go to your investing activity. When you're going to get interest on your investments of a deposit, whatever may be, then it has to go to your investing activity. But if suppose your customers on delay payment, it can be your operating income. Cash flow arising from interest paid and the interest and dividend received is the case of financial enterprise, should be classified as a operating activity. For other enterprises, it is a investing or financing activity as the case may be. Dividend paid is always a financing activity because you are making a payment to your shareholders for the amount given to you for running the operations. The total amount of interest paid during the period has to be disclosed in the cash flow statement separately, irrespective of the fact whether it has been routed through P&L or through balance sheet by way of capitalization. Normally, as per the borrowing cost, we would have capitalized some of the interest element as a part of cost of fixed assets. So when you are giving a cash flow statement, you have to bifurcate that and you have to show that interest element as a separate line item under the cash flow and not as a fixed asset. So interest paid and interest received and the dividend received are usually classified as operating cash flows for a financial enterprise that we discussed. However, there is no consensus on the classification of cash flows for other enterprises. Some argue that the interest paid and interest and dividends received may be classified as operating cash flow because they enter into a determinant net profit or loss, because that is always grouped under your other income or other expenditure or finance cost. But it is clarified that it is not possible. It has to be shown as you are investing or financing, as the case may be. Similarly, dividend also, there is an argument that it has to be shown under operating cash flow because based on this only generating income. That is not correct. That has to be classified as financing activity because that is paid to the owners who made investment in this entity by way of share capital. Taxes on income. Cash flow, we are going to discuss this standard AS 22 in detail in the subsequent presentation. But for this cash flow statement, the taxes on income to be shown separately under the head operating activities unless it is specifically identified with financing and investing activities. I'll just explain this in detail. As I said earlier, suppose the company is selling an investment or, for example, a land which was earlier carried at cost. The value is 1 lakh as books, but the company is going to sell it at 1 crore. The gain on the sale is 99 lakhs, on which the company is going to pay 20% tax, assuming it's 20 lakhs. It is not prudent to show the 20 lakhs as your operating tax expense. So, though by default, all the tax expense will be shown as operating activities, but this is being identified item. It has to be grouped where this income is shown. This income on sale of fixed assets will be grouped under your investing activity. Obviously, this outflow also to be grouped under investing activity, not otherwise. Similarly, your any tax on your financing equity, for example, as I told you, dividend paid. Previously, it was dividend distribution tax was there. Any tax paid by the company has to be grouped there. Similarly, any tax impact on your interest payment on borrowing. Because if suppose you are making any payment to a overseas country where it is net of tax, if any tax is borne by the Indian entity by way of grossing up, that tax also has to be shown as investing activity and not as operating activity. So we have to analyze that tax outflow into 3 heads, whether it is related to your operation or whether it is related to your investment or related to your finance. So accordingly, we have to show the cash inflow or outflow of accordingly to give a realistic presentation. Subsidiaries, associated joint ventures, it has always investment. So we need to show on a net basis where is the cash flow, and accordingly we have to present it. Acquisition of subsidiaries and disposal of subsidiaries. As I said, any investment in a subsidiaries is always your investing activity. So we have to show the total purchase or disposal of consideration as a separate line item under investing. Similarly, any portion realized by way of disposal as a separate line item. They have to aggregate the subsidiaries, business units, JVs, whatever may be. In investment, where we can show investment in subsidiary, joint ventures, or associate as an outflow. Similarly, whenever there is an inflow, it can be shown under that head. Similarly, any dividend income received from a subsidiary or associate, whatever may be, there can be an inflow of cash. So under the respective head. There are certain non-cash transactions. As you are aware, all transactions in the P&L and balance sheet need not be by way of cash. There can be certain non-cash. How it can be? You would have purchased the inventory by corresponding liability. You would have taken out from a group concern. Or in case of a slump sale purchase, you would have purchased assets along with the liability. You would have purchased certain assets by way of discharging it by way of your equity or debt. You would have given debentures. You would have given some borrowing. So these things are not directly linked to your cash. It is a non-cash transaction. So specifically, the standard says that these things to be excluded while preparing the cash flow. But we need to give separate disclosure what are the non-cash transactions not considered in the cash flow statement, so that the user can understand and evaluate this implication in the financial statement. You would have seen in the equity capital, we will be giving a note saying that what is that equity allotted to India without for a consideration other than cash. If there is any such consideration, that equity will not be shown as a cash inflow from your financing equity. This will be excluded from your cash flow statement itself, so that the corresponding asset also will be removed. If you are going to, if you acquire any fixed assets by way of equity issue, then both the assets as well as the equity will be out of your cash flow. This we have to bear in mind, because most of the mistakes happen in this area. Whenever you are preparing financial statements, you will go based on the line items without understanding what is the background transaction. So we need to evaluate each and every line item critically. If it is very insignificant amount, there is nobody is going to bother. But if there is a significant transaction to the year without movement of cash, then those things to be captured correctly in the cash flow statement and it should not be included, because this has no cash inflow or outflow as regards the transaction concern. The standard gives you examples. The acquisition of assets by assuming directly related liabilities, as I told you, there can be a transaction by way of slump sale, wherein you would have taken out certain assets and also along with the liabilities, net amount you are given as shares or whatever may be. acquisition of enterprise, beginning of issue of shares. Normally it will happen, merger of entities, taking over of another company or other unit. So normally these things without any issue of shares, any issue of cash. Sorry. Conversion of debt into equity. It is a movement between liability and equity. So there is no cash movement. So you can't show that settlement of debt and receipt of equity. These two things to be removed from your cash flow statement. Then what is the component of cash and cash equivalents? So they should disclose what is the components of cash and cash equivalents. It consists of cash balance, then deposits with the original maturity of less than 3 months, etc. And we have to give a reconciliation between the last year figure and this year figure. This difference will tally with your sum of operating, financing, and investing. So each company may have different cash management policies. So they have to disclose what is the policy and whether they are following it consistently. That is more important. Whenever there is a change in the policy, it will be treated as a change in accounting policy under AS5. We need to disclose those things also and impact on the financial statement. This is also one of the area where there will be mistakes because they will not disclose what is the cash management policy of the enterprise, and accordingly, and the reconciliation also in a few cases I have noticed that it is not given. They just put what is the net increase in cash and cash equivalents, and finally they will say final closing balance, but they will not link to the notes of accounts so that they can check that. Better thing is to put those reconciliations in the face of cash flow statement, so it will be easy for the readers to understand how it has been prepared. Other disclosure is the management need to disclose if there is any cash and cash equivalents which they feel is not available for use by it. There can be chances if the company is having a overseas subsidiary where there is some restriction, they can't move the money. For example, now the Sri Lanka is facing some difficulty. Previously, Indonesia had some liquidity problems where they can't transfer the money beyond a certain limit. Then the amount, though it is cash and cash equivalent, it will not be readily available. As per their balance sheet, may be cash or bank balance, but the company, holding company perspective or main company, which is the branch in that goes entry, from the company's perspective, it may not be readily available. So necessary disclosure has to be given in the financial statement saying that there is some restriction in the usage of money. So we have to remove that from the cash and cash equivalent by way of note and as not available for immediate use, and do the reconciliation properly so that the user can understand what is the amount the company can replace immediately for the requirements. These are the observations. See, normally any balance sheets, mainly listed companies will be compulsory reviewed by FRRB, Financial Reporting Review Board, as well as QRB, Quality Review Board. For small entities, they will be taking it on a random basis and they will review. And there are certain publications now with 3-4 volumes have come highlighting what are the mistakes generally happen, what is the view of the institute and what reviewer, and how it can be corrected. So on the broad head, these are the common mistakes noted by those regulators. So one is non-disclosure policy. So cash and cash equivalents, cash flow statement preparation method, etc., to be disclosed properly. But normally this will be missed because they will take it as so lately. There will not be any separate disclosure. It is 3-4 lines, just like your accounting policy. You have to disclose your policy on cash flows. That is a must. Non-cash items are reported. Similar, namely profit on sale of assets, accrued interest not adjusted. The company would have made a provision for doubtful debts that not been added back. Unless you add back that, you can't arrive at the correct realization of returns. But normally that will be missed out. Profit on sale of assets, it will be in your other income or other expenditure. That will not be added back in your cash flow computation, so that your sale proceeds on sale of fixed assets will not be correctly captured. Interest accrued is a very common mistake. Interest accrued as well as interest is both for deposits as well as for your liability. You will be providing outstanding interest for your borrowings on 31st March, but the P&L will have accrued interest also. For example, you are paid till 20th February, you would have provided interest for 1 month, 31st March, but that 1 month interest is not paid. So you have to adjust that amount from your P&L balance and show the correct outflow as a outflow of interest. But this 1 month interest has to be added to the profit. Then only operating profit will be showing correct picture. This adjustment will be missed out. Similarly, your deposits, accrued interest, this adjustment will not be done. So they will be taking the increase or decrease in your deposits alone as a cash flow. That is not correct. We have to do the adjustment for the interest also. Working papers. See, whenever the review is there, we must have working papers, how these line items have been prepared. Most of the cases that is not produced to the regulators when they come for review. So that is one of the qualification. Reporting of cash flows on net basis. for non-permitted items. So there are certain items where you can show the cash flow on a net basis, as we discussed earlier, but there are certain items where you cannot net those items. For example, long-term debts, you are getting a term loan from bank and you're repaying those loans in the same year and also subsidiary year, you can't net these two. Receipt of loan is different and settlement is different. You're making the payment based on the repayment pattern. You will be paying your 10 months installment fallen during the year, but that is different than the amount what you received, which is repayable over a period of 60 months or 180 months, whatever may be. So we should not net it off. But normally the companies will net these balance for net inflow of loan. That is not correct. Investment in assets, shares, etc. We have to show on a gross basis. Investment has to be a separate item of outflow, and the sale proceeds has to be shown as separate item as inflow. Not reporting borrowing costs separately. This is one of the common mistakes, because the company would have capitalized the interest on borrowing costs as a part of fixed assets, but that would have been disclosed under the fixed assets PPE schedule. But while preparing the cash flow, that would have been missed. That interest is shown as an increase in investment in fixed assets rather than showing as a borrowing cost separately. So this adjustment is received repeated attention of the regulators, and they pointed out this mistake. Non-cash items not adjusted. It is also one of the very common mistake. Right back, I told you provision for doubtful debts, unreleased forex gain or loss. Those things normally it will be missed out, because it will not be material in some of the cases. Some cases even material items are missed out. We have to be extra cautious while doing these type of corrections. Reconciliation of opening closing cash and equivalents are not presented. They will just put what is the cash flow from operating activities, what is the cash flow from financing activities and investing activities. They will add these three and put that amount without any reconciliation. That is not sufficient. You have to reconcile with the opening balance and arrive at the closing balance. And for closing balance, you have to give the details how it is represented, whether it's a cash and cash, how it is being. You have to give the detail. Identification of cash and cash equivalents. Ineligible deposit classified. See, normally the bank deposit, they will take a later mean saying everything is eligible within 3 months. That's not case. You have to be specific. If it's a long-term deposit, you have to show as a investing activity. Any deposit made in the bank, which is mature after a period of 3 years, normally will show as an investing activity, not as a cash equivalent. You have to be extra cautious in that. Dividend received is not disclosed in investing activity. It's a very common mistake, because the amount may be insignificant, because the company's investment, unless it is a very large company where the investment is made in subsidiary, the dividend income is very large. They would have made some small investment in some shares. They would have received 10,000, 20,000 rupees as income from dividend. That will go on other income. It goes unnoticed. But that is not correct. Irrespective of the amount, it has to go under the respective head. So this is the first standard. I'll run you through one of the example of the cash flow statement after I complete my other presentation also, because we'll go the practical cases simultaneously. Person has raised hand. This person, can you type or you can unmute and talk? Either way.
Sir, participants can unmute and talk, sir.
Yeah, please, Prasanna, can you please? I think he's lowered his hand.
Okay. Or else the participant can post in the chat box.
Yeah. Yeah, some query has come. 1 second.
Okay.
Where to show interest on deposit given as margin money. So obviously it is you are investing the amount and any income received from that is your investing activity. Always any deposits, margin money is not always will not be short term. It will not be for 3 months. It will be for more than 3 months or 1 year. Some cases it will be for a longer period also. So any interest income on deposits as margin money is your investing income.
Sir, one participant has asked, is EMD considered cash equivalent?
No, EMD is not a cash equivalent.
If EMD amount pending with vendor, which is more than 1 year.
No, irrespective of the month, EMD is not a cash equivalent.
It's not a cash equivalent.
Normally, EMDs will be treated as operating activities. The net increase or deposits. So margin money for bank guarantee, is it cash and cash equivalents? See, it is normally given as a lien to the bank. So you can't get that money back. So obviously it will be it will not be treated as a cash and cash equivalent. Yes, sir. The standard is applicable to all companies except that initial 3 exceptions are given. That is a one-man company, a small company, and different company. Other than that, it's applicable to all. Even the accounting standard rules 2021 notified recently, it's the same thing. So there is no exception. But even for these 3 entities, it is optional. If they want to prepare, they can prepare. Otherwise, if they prepare, they have to comply with the standard in toto. They can't be pick and choosy. So it is literally applicable to all because those 2 entities are very insignificant in number. So obviously, this cash flow statement is applicable to all.
So what is the difference between direct method and indirect method?
Yeah, direct method, see, you'll be selling from amount realized from your sale of products. Gross, everything is grossed. But indirect method, you'll be starting, I'll show you the example also. You'll be starting from your profit as per P&L. I'll just stop the sharing and I'll show the standard. It will have a better understanding. 1 second.
Sir, one more question.
Yeah.
Are there any rule to follow which method, direct or indirect to follow whether a company?
No, the standard says you can follow direct
Management.
method that is more readable, but everybody follows indirect method. No one, I have not seen any of the balance sheet preparing under direct method. That is too cumbersome. And one more question, sir, fixed assets purchased on hire purchase on 31(3) is a non-cash activity. If there is no cash flow, see, you have to see what is the significance of this transaction. If it is a normal, it can be treated as 2 way. Either it is a loan received from hire purchase and it has been purchased on fixed assets. If it is insignificant, you can show as a total fixed assets. But if it is significant transaction which is purchased without any cash settlement, definitely you can defer that because it is a non-cash transaction. But normally for any vehicles purchase and hire purchase or any vehicle acquired on a loan from bank, this is only contra entry. We will not show it as separate line item. It will be treated as a normal purchase and a normal loan transaction.
I think no other queries, sir.
Yeah, 1 second. I'll just share that.
Sir, is there any punishment or crime-like thing if you show the operating activity as an investment activity or something like that to tally the cash flow statement unknowingly or whatever the case may be?
Definitely, there will be a regulator when it's taken for review. They may send a notice to you why it has a mistake, and if it is negligible negligence, then may issue a warning. That is all. Otherwise, the institute can take the steps as per their procedures. But regulators, they can also issue notice that as a non-compliance of accounting standard. It will be treated as a non-compliance of accounting standard.
Okay.
I think you can continue, sir. the
Yeah,
session.
I think he's.
So this is the standard.
Yeah.
The screen is visible, no?
Yes, sir.
Yeah. So this is the
Request
example.
you some magnify the same, sir.
Pardon?
Just plus button, the magnify the same, sir. That plus
Make it
button.
big,
Yeah,
sir.
yeah,
Make it big, yes.
yeah,
Is it better?
yeah, yeah. Now it is good, sir.
So this is the balance sheet they given. I'll just see the cash and balance as 225 and all. This is a normal balance sheet. And again, the P&L. For example, P&L depreciation. This 450 is a non-cash transaction. Interest expense, we have to check separately. Interest income, separate. Dividend income, foreign exchange loss, 40 rupees. How it is shown? Extra items, insurance proceeds from earthquake and this at 180. Income tax is 300. Under direct method, they are starting with 30,050 cash receipt from customers. How this amount has come? Your sale is 30,650. But your debtors, 1,200 to 1,700. So 500 rupees has gone up. So though you have sold 30,350 worth of item, 500 rupees not received. So 30,150. This is the direct method. So for some of the items you can directly prepare from the P&L balance sheet. Some of the items you need to look into the books of accounts. So this is not the easiest way. Similarly, for example, supplies and employees, everything will be from the gross outflow basis. So this is the cash generated from operation 2,550. Then they deduct income tax paid. What is the cash flow before extraordinary, and what is the discharged extraordinary items due to that, and what is the net cash flow from operating. This is the one way to prepare. Indirect method, if you come, they will start from profit as per P&L 3,350. Nothing but your final profit as per this statement 3,350 before your extraordinary item. That is the starting point. They will add the depreciation because this is a non-transaction. Foreign exchange loss 40 is added. Interest income is deducted, and your dividend income is deducted. Interest expense is deducted. Operating before working capital changes 3,740. Then they will do the adjustment for debtors 500 minus we discussed earlier. Inventories, what is the net decrease, and what is the any decrease in asset is a inflow. Any increase in asset is a outflow. That is a way for preparing in indirect method. So cash generated from operating 2,550. Income tax paid is 860, and proceeds from earthquake disaster is 180. Operating 1870, under both the method the amount will be same. This is under direct method 1870. This is under indirect method 1870. After this, everything same. There is no change. Once you prepare operating expenditure, then your investing activity and financing activity under both the methods will be same. Only for preparation of cash flow under operating activities, you have two choices. One is direct method, other is indirect method. So direct method, though the standard says this is more appropriate to present because the reader will be in a position to understand what is the amount generated from your customers, what is the amount paid to the supplier, employees, etc. But most of the entities use only your indirect method because that is easiest way to prepare, also easier way to understand. Otherwise, giving a schedule for direct method is more difficult than giving a schedule for this indirect method because most of the things are directly from the P&L and balance sheet. You can just refer the note number. For the direct method, it is a bit difficult. And this is a reconciliation. What is the cash and balance at the bank opening, short-term investments, and cash equivalents, and effect of exchange rate changes. This is the closing movements. This way we have to reconcile. Most of the cases, this reconciliation will not be published in the accounts. There only the problem arises. They will just complete up to this level 910. They will not give this note. If you have financial statements of the details in the separate note, you can refer the note. Otherwise, better to give that note under the cash flow statement itself. And you have to give a policy. Cash and cash equivalents consist of cash on hand and balances bank and the investment money market instrument, and this consists of the following and do reconciliation. This note is a better way. And we must have working notes for each and every item. I will show you Excel file also after I complete the next presentation, how to prepare that Excel file so that it will be easy. But each and every item, what you are giving the cash flow statement, better to have a reconciliation working so that any query from a regulator at later date will be easy to substantiate. We would have done some adjustments based on certain assumptions while preparing the financial statement. When we get a query after 4 or 5 years, we may not be in a position to recollect for what purpose that adjustment has been done. So better to have a working whenever you prepare a cash flow statement, it will be easy so that while preparing itself, you'll know if any mistakes is cropping up that can be corrected then and there. Any further queries on this cash flow? Is exchange gain or loss on account of sales should be shown separately in the cash flow statement? No. See, the P&L will be showing any exchange gain or loss as separate line item as expenditure or income. Any unrealized gain or loss has to be added back and presented separately, because realized is always grouped under operating activities. So there is no need to adjust realized gain or loss. Unrealized gain or loss to be added back or deducted from your computation when you do presentation under indirect method. Explain realized and one more query. Explain realized and unrealized foreign exchange conversion item. Realized. See, for example, I will tell you why. I just open an Excel sheet. It will be easy for you. 1 second. Are you able to see the Excel sheet? Hello?
Yes, sir. Yes, sir.
So, for example, you are making a sale, $1 lakh, assuming 70 rupees the exchange rate on the date of transaction. 70 lakhs would have been debited to customer and credited sales. Transaction over. While suppose of this 1 lakh, you realized $50,000 on before the year end, say assuming at 76 rupees. So 1 rupee you receive extra. So 38 lakhs, of which you will be passing an entry. Debtors 37,50,000. So you collected 38 lakhs from the customer, of which 37 lakhs 50,000 relates to your debtor already accounted, balance 50,000 is your exchange fluctuation. On 31st March, you have not realized that 50,000 rupees. So assuming that on 31st March, the debt is 80 rupees. So 40 lakhs. So of 40 lakhs, you have to increase your debtors by 37 lakh 50,000 already there. So you will be adding 2 lakh 50,000 from your debtors account and crediting 2 lakh 50,000 as your exchange fluctuation income. So your P&L account will have an exchange fluctuation of 50,000 plus 2 lakh 50,000 as a credit, of which realized is 50,000, unrealized 2 lakh 50,000. So this amount is not no issue because amount is already realized. It will be showing as a income from operations because this is realized from debtors. So no issues. But this unrealized portion you have to add back to your profit so that this is not a cash flow item for this year because generation will come in the subsequent year. So this item, this is unrealized. Hope your query is clear. few more queries.
Thank you, sir. Thank you. Yeah, it's clear.
Are there any rule? I told you there is no specific rule. You can follow whichever of the method, whichever best suit to you. Direct and other method I shown clarified. Standard of rule. Any questions I missed out? Please let me know, madam. Sir, cash flow is required both for standalone as well as consolidation. Sir. There is no exception. It is to be prepared for all financial statements. Notes need not be given in the cash flow statement. Notes you need to have in your file. Only thing is reconciliation of cash and cash equivalents to be given in the cash flow statement, or you have to refer the note where it is available in the cash flow statement. But accounting policy is matter relevant. These notes and workings are your working file. Can you explain again on the exchange gain or closing? Is it? I think I have clarified with the Excel sheet. Mr. Aranathan sir, is it okay, or you want to explain it again?
Yeah, it's okay, sir. Thank you.
Yeah, thank you. Kishore Babu has asked why you need to add back unrealized exchange gain. Anyway, the increase or decrease in debtors will take care of. No, it will not take care of it because you are going to treat it as a non-cash flow item as a cash flow. That is not correct because this element is different. Your debtor, closing debtor has this unrealized gain. You have to exclude this and see what is the amount realized. For example, in the same case, your debtors now, assuming this is the only transaction of the company, your closing debtor will be having 40 lakhs. And opening balance is 0. Increase or decrease, you'll be showing us 40 lakhs because the opening balance is 0. So, collection increase or decrease in debtors is 40 lakhs, of which only 37,50,000 is the debtors movement. Increase or decrease, 2,50,000 is nothing but your cash flow. So, unless you add this unrealized gain, your increase or decrease will not show a correct picture. You have to show 250 as addition to your P&L and this 37,50 as your increase in debtors. Two participants are raised hand. You can unmute on us, sir, or you can type in the chat box.
Hello?
Yes.
I typed 2 times on that, but no response from you. So EMD payment, we made in advance. We can consider as a cash equivalent if you hold the endowed by the more than 1 year.
Which one, sir? Which one?
EMD.
EMD, I already clarified. No, EMD is never a cash and cash equivalent, sir. It is always your, just like any other advance, a customer advance.
Okay.
Irrespective of the period, whether it's going to realize within 3 months or 1 year, that is not at all a cash and cash equivalent. Okay. It will be coming under your operating activity because it is EMD is paid for your operations. So any increase or decrease will be shown as a movement in your operations, operating activities, not under other heads. It is not your investment. It is not your financing activity. It is only paid for the purpose of your operations. So any increase or decrease will be grouped under operating activities.
Okay, thank you.
Just like your trade advance given to your customer, you are giving or party is retaining one portion out of your proceeds. That is all.
Okay. Thank
cash
you.
And cash equivalent nothing but the amount parked by you in your banks or investment made by you, which is really encashable, only come under cash and cash equivalents, not under loans and advance. Because EMD will be grouping under loans and advance account, that will not come under as cash and cash equivalents. Anything shown under cash, bank balances, and investments. If it is really encashable, it will be as cash and cash equivalents.
Okay, sir. Thank you.
You're welcome, sir.
Excuse me, sir. Excuse me, sir.
Yeah, please.
Sir, actually, while valuing the debtors using closing exchange rate, we would have debited the debtors and credited the forex exchange gain, right, sir? So we have to eliminate that exchange and the notional loss from the profit, and again we have to eliminate the notional loss. I mean, notional gain from debtors.
Yes. Then only you will know the exact. See, in this case, I have said opening balance 0. Normally, it will not be the case. Opening balance will somehow have some amount. Under the closing balance will have a different amount. Unless, see, for example, in this case, the total data was 75 lakhs originally. Now you are going to get 78 lakhs. Of these 3 lakhs, 50,000 is realized gain, 2,50,000 is unrealized gain. So when you are going to compare this amount, then what I have to show is 2,50,000 I have to add back to the profit and show the increase.
Time changes.
Can you make it big, sir? Can you make it big? The screen.
Hello?
Yes.
Okay, sir. Thank you, sir. Oh, understood, sir.
Yeah. So one query has come. Mutual fund was classified as a cash equivalent. Subsequently realized that it's not a MMI. So that is a mistake, sir. Unless without a proof, we can't say now the financials. That is not excuse. The regulator will not agree on that. So we have to be extra cautious. Whenever you're grouping something under cash and cash equivalent, we ensure that it is even if you have a year out, group it under your other non-current and treat it as your investing activity. So it will be safe. Thank you. So I'll go to the next one. Any further query, you can type that. I will handle once I complete the next presentation. Madam, can I proceed?
Yes, sir. Yes.
Any unanswered queries, you please mail to the institute so that I'll ask them to send it to me so that we can send a mail to you back. Yeah, the next one is regarding your taxes on income that is covered under AS 22 and accounting for MAT credit. So these two things are totally different but lately connected. What I suggest is AS 22, there is no exception. It's applicable to all. There is no, just like cash flow, small companies are one-man company are exempted from a preparation of cash flow statement, but AS 22, there is no such options. Everybody has to prepare, comply with the AS 22 requirements. That is tax on income. What is the objective? The standard is just to give your accounting treatment, how this taxes on income to be accounted in the financial statement. That is the simplest thing. Everybody knows that whenever you are making a profit, you have to pay tax. Let's assume that for simplification, the entire presentation, I will use the word 30%. Suppose you are making 1 lakh gain, then you have to pay tax of 30,000 rupees. If your salary is 1 lakh, you have to pay tax of 30,000 rupees. Your income from investment is 1 lakh, you have to pay tax of 30,000 rupees. This is the 30,000 is your tax. How this 30,000 to be presented in a financial statement? That is the purpose of this standard. It's very simple standard. It's very few pages. One of the easiest standard to comply with. So we'll look into these things in detail. Because though I have been told to cover more on deferred tax assets and liabilities, I just touch upon the basics of the standard so that it will be giving us an idea as to how to comply with the deferred tax assets and liability recognition without any difficulty. As you are aware, taxes on income is one of the significant items that P&L. Once you arrive at a profit before tax, 30% is your tax liability in the normal case. Unless you are going for this 115 BAB, BAA, whatever may be, normally it will be 30%. And similarly, when you are going for your MAT tax, it may be at a lower rate. Then also there comes a MAT credit to come into picture. I will explain that also in detail. What is the necessity for this standard? Normally, when you are preparing a P&L, you will be preparing based on the book depreciation, assuming that the profit before depreciation is 1 lakh. So this profit will be common for both book profit as well as IT profit. But in books, depreciation is 20,000 rupees. So your profit after depreciation before tax is 80,000 rupees. But for this same asset in income tax, you will be claiming a depreciation of 40,000 assuming. So in tax memo, the taxable income will be 60,000 instead of 80,000 compared to the book. So 80,000, you are going to make a payment of tax on 60,000 rupees at 30%, so it will be 18,000 rupees. But in book, if you are going to put 18,000 on your 80,000 as a denominator, it will not be 30%. It will be only 22.5%. So what is the reason? So definitely you have to pay this amount in a subsequent year. That comes into the deferred tax assets and liability coming into picture. We will discuss those things in detail. But the purpose of objective of standard is to guide us on the matching concept so that the expenditure and income occur on the same period as with the revenue and expenditure. So the standard is applied to tax on income. It's include your tax expense or saving. See, the standard is not only payment, it's always for credit also. Any refund from the department also to be considered the standard. It covers both the domestic and foreign taxes. And also the standard does not talk about any tax on dividend distribution tax or any other distribution made by the enterprise. So we are not going to discuss on those. We are going to discuss only on your tax payments on account of your profits. Sorry. Let us look into some of the definitions. Accounting income or loss is the net profit or loss for the period as reported in the statement of P&L before deducting income tax expense. Nothing but your profit before tax or loss before tax. Taxable income or tax loss is the amount of income or loss for the period determined in accordance with the tax loss based upon which the income tax is payable. Based on your book profit, you will be dissolving the depreciation as per books. You will be claiming IT depreciation. You will be making lot of disallowances under 43B, 40A, 1A, whatever may be, and arriving at the taxable income on which you are going to pay tax. So that is taxable income. Tax expense is the aggregate of the current tax and deferred tax. Here they are using the word deferred tax. We will come to deferred tax in detail in the subsequent slide. So, but in tax expense, if you say it is aggregate of both current tax as well as deferred tax, then what is current tax? Current tax is the amount of income tax determined to be payable or recoverable in respect of the taxable income of the period. So this is the amount payable or receivable from the government on your profit. Deferred tax is nothing but a tax expense on the timing differences. What is the timing differences? That also I will come to you in detail. Definition of timing differences: difference between taxable income and accounting income for a period that originated in one period and are capable of reversal in one or more subsequent period. One simple example is 43B disallowance. You have not made the payment before filing of return, that will be disallowed. So whenever you are making payment, you will be claiming that as a deduction. So it is a timing difference. For disallowance in 1 year, allowed in a subsequent year. That is the timing difference. Permanent difference are the differences between taxable income and the accounting income, which originate in one period but do not reverse subsequently. Example, donation paid may not be allowed. ATG you may get for 50% in some cases, but assuming that there is no deduction. CSR expenditure, permanent disallowance. Any other items for which there will not be any deduction under Income Tax Act. For example, interest paid on delay filing of return, interest paid on delay in payment of tax, your penalties, etc., are permanently not allowed for tax purposes. So the difference, you would have charged those items in the P&L, but it will not be claimed as deduction in income tax. These differences are one-time differences. It will not be allowed for this computation of income taxes. Always taxable income will be calculated according to tax laws. In circumstances, those laws require taxable computation difference. Various accounting policies because due to differences. For example, under books, we will be calculating depreciation on trade method. For tax purposes, you will be going with block up concept. So definitely there will be some differences. So because of this, every time there will be difference between your taxable income and accounting income, and never they'll agree. In every company, whatever maybe even if there's very small transaction, there will be difference between your book profit and tax profit. So this has to be analyzed into two parts. One is a permanent difference, other is timing difference. In addition to that, there will be unobserved depreciation and carry forward losses, which can be set off against future taxable income. Also treated as a timing difference as deferred tax assets subject to consideration of prudence. This part, unobserved depreciation and carry forward losses, I will discuss in detail in subsequent slide. But these are the adjustments. One is 43B disallowances, your disallowances towards penalties or interest payments, which is not allowable. Those are permanent differences. 43B or 41A disallowances are temporary disallowances because you will be allowed to claim in the subsequent year. In addition to that, there is a carry forward of losses in your return, which is eligible to set off in subsequent year. That can be also treated as deferred tax asset, provided subject to prudence, which we will be discussing in detail in subsequent slide. Recognition. Tax expense for the period comprising current tax and deferred tax should be included in the determination of net profit or loss for the period. So you have to, while preparing the P&L, profit before tax less tax expense must consist of two items. One is current tax, other is deferred tax. Aggregate of these two is the total tax expense for the year, and after this only you will be arriving at profit after tax. These taxes on income to be mapped to the year in which the income and expenditure relate. So your tax, unless it is there is no permanent difference, your income tax and book tax must be same. 30% means you have to aggregate of your current tax and deferred tax. Your 1 lakh is your income. For your tax purpose is only 50,000 rupees. So 30% of that is you will be paying 15,000 rupees as the tax liability. For book also you have to provide 30,000 as 30% tax, of which 15,000 is your current tax, 15,000 is deferred tax. I will explain how that will come, but this is the basic understanding. If there is no permanent disturbance, everything is timing different. Your tax liability as for books also must be the same percentage as in the tax statement. Amount may differ. One is your current tax, that is 15,000 as for IT computation. Balance 50,000 is your deferred tax, which will be paid in the subsequent year or recovered in the subsequent year. So deferred tax should be recognized for all timing differences, subject to the condition of prudence in respect of deferred tax assets. So liability is the mandatory, you have to account for it. Assets, you have to check the prudence. There are 2 levels of prudence. We will come to that in the subsequent slide. Examples, as I told you, deferred asset, nothing but 43B dissonance. This is the simplest example. So every company will have some dissonance under 43B. So that is obviously you will be creating a deferred asset. Liability, simplest example is depreciation. In books, we will be claiming depreciation at 20% for 5 years on straight line basis, but income tax you will be claiming depreciation 40%. So first year the claim will be 40 as against 20 in the books. That is the difference of 15 rupees. Over a period, income tax depreciation will come down, but this will be constant for 5 years. After that thing, this will become book will become 0. IT will be claiming depreciation a small amount. So there is a timing difference. Permanent difference do not result in deferred assets or deferred liabilities. That is a one-time adjustment. We will be showing only in the reconciliation. Simplest thumb rule is any item claimed in the IT over and above what is charged off in the P&L is your liability, because you have claimed a certain item over and above your book profit, and because of it you are paying a lesser tax. So the tax has to be paid in subsequent year to the department and will be accounted in the books. So it is a liability. Any amount charged in the P&L disallowed in the memo, which will be allowed in subsequent year, is your asset, because of that you are paying more tax to the government in the current year, and you will be claiming making a lower tax in subsequent year, but it is already charged off in your P&L. So this is the concept. So any claim over and above what is there in the books is your liability. Any claim less than what is charged in the book is your asset. Thumb rule. But permanent differences, there will not be any adjustment. Always that is a one-time correction. Deferred tax. Examples as per the standard is one is 80 IA and 80 IAB. There will be some holiday period, 10 years, whatever may be. The difference, the timing difference may originate in the tax holiday period and reverse in the tax holiday period itself. For example, depreciation example I told you, in the 5 years you will be claiming depreciation on straight line in the books 2020. I will show one example also, but for theoretical I am telling now. 5 years you will be claiming 100 rupees as depreciation in books. But income tax, first year you will be claiming 40 rupees, and second year on 60 rupees you will be claiming 40%, that is 24 rupees, like that will go on. So some of the adjustment, the difference between this 40 in the first year and 20 in the books, 20 rupees is the deferred tax liability, but over a period it will be reversed. But if reversed within the 10-year period, then that will not be accounted as a timing difference. Whatever is carried over post the tax holiday period alone will be considered for books. Similarly, for 10A, 10B also the same logic applies. So deferred tax in respect of timing difference which reverse after the tax holiday period is recognized in the year in which timing difference originates. For example, the first year the 15 rupees difference, if a part of it is reversed after the 10-year period, then we will be recognizing that amount. We will not account the entire 15 as a deferred tax asset whenever that we are claiming 10A, 10B or 80AB. In the year 1, we will be claiming only the net amount which is reversed after the 10-year period. So the standard requires recognition of deferred tax asset for all timing differences. This is based on the principle of financial events of the period should be recognized the tax effect, whether current or deferred, for all transactions occurring in the period. So for this purpose of reversal, we will be taking first come first out. We will not go into detail on much on that, but this the standard says you have to go by the first in first out, and we have to compute this deferred tax for all timing differences unless permanent difference. Let us see a case study, because this is too theoretical. Taking everything to brain will be difficult for everyone unless they have a practical experience how they prepared this. deferred tax statement. Just one example as per the standard only, but it's very good example. It covers all the areas. So I'll just run you through this example. The income before depreciation and tax of an enterprise 15 years, 1,000 rupees, 1,000 lakhs per year. So simple thing, they're taken for 15 years example. Every year the company is making a profit of 1,000 before depreciation, both as per books as well as IT. Enterprise is eligible for 100% tax holiday for the first 10 years under 80IA. Tax rate is assumed at 30%. At the beginning of year one, the company has invested a machinery for 1,500 lakhs. Present value is nil. So book purposes, it will be provided depreciation on cycling basis over a period of 15 years. So every year the depreciation charge will be 100 rupees, 100 lakhs. For tax purposes, the rate of depreciation 28% on WDV method. We are ignoring MAT, though MAT is also applicable for this case. For the purpose of the example, we are not going to discuss on MAT. I will discuss on MAT on separate example, because if I talk about MAT on this example, it will confuse a lot. So let us not go into MAT for this time being. Let us understand this deferred tax asset and liability alone based on this example. How it will originate, how it will reverse. Simple thing is, deferred tax asset in the normal case, as I told you, that also I'll show an example. It will be easy to understand, but for this case, we are going to see how it is originate and when it reverse, how it is accounted in the tax books. As I said, the cost of the asset is 15 lakhs, 1,500 lakhs. In books, we'll be providing, hope you are able to see my cursor, 1,100 rupees per annum straight-line basis, 100 lakhs per annum. So total 15 years, total depreciation charge is 1,500. In IT, we will be claiming 20% per year. First year on 1,500, 375 is the depreciation amount. Second year, 281, 211 like that. On completion of 15th year, the total depreciation claim is 1,481. So of the total amount capitalized 1,500, 1,481 is claimed in 15 years. Balance unclaimed is 19 lakhs. That is carried over on 15th year. That is the double DV as per IT schedule on expiry of 15 years. So have these two things in mind. 1,500 fully depreciated in the books, but 19 rupees is pending in IT. This they extend in the first example. 1,000 rupees is common for all the year before depreciation. 100 rupees is the depreciation for all year as per books. So 900 is the income after depreciation. It's nothing but profit before tax as per books. So gross total income after deducting depreciation and the tax loss is your 1,000 rupees minus the depreciation, what is allowable under tax law 375, 281, 211, etc. So then tax profit is 625, 719, 789, like that it will come down. And the company is eligible for 100% 80IA, the first example we have shown. So the entire 625 will be directed for the first 10 years. The taxable income will be 0. And from 11th year onwards, the entire tax income will be chargeable, 979, 984, 988, 911, etc. So this thing. Total difference between your book profit and the tax profit is, for the first 10 years is 900 rupees, and the next 5 years is 79, 84, 88, 91, 93. What is the permanent difference? Of which 80IA, it's the one-time reduction. The company is not going to do anything. It's a benefit given to the company that will be treated as permanent difference. No adjustment under deferred tax assets or liability. So that will be directed. The net difference is 900 minus 625 is 275. That is originating. This year it is a new created. So next year is 181, 111, 58, 19, etc. And this started reversing. See, first year is 900 is the amount, of which 625 is the 80 permanent. So 275, your book profit is more. IT profit, the difference between these two is 80A because of permanent difference. Temporary difference is 275. But on years 5, your difference is 900, of which excluding the permanent difference, the difference is 911. So it's going up. So you have to reverse 11, 33, 50, 62, 72. 10 years, your tax holiday period is over. So amount reversed from year 6 to 10, 11 plus 33 plus 50, 62, 72 is 228. First year, you are there is origination of 275, but the deferred tax liability, but it is reversed within the period of 10 years is 228. Amount to be reversed after the tax holiday period is 278 minus 228. From 11th in order is routine one only. You are not in a tax holiday period. There anything is so year 2 181 is originated in year 2, but not reversed in the tax holiday period. So it will be reversed in subsequent period. It will be crediting liability. We will go to the slide. So this is a note. Timing difference originating during the tax holiday period. 644 lakhs. This one. Of which 228 are reversing during the tax holiday period. How this 644 is coming is 275 plus 181 plus 111 plus 58 plus 19. Aggregate is 644, of which 11 plus 33 plus 50 plus 62, 72, 228 is reversed within the tax holiday period. And 416 are reversing after the tax holiday period. Timing difference of 19 is originating in the 15th year and reversing subsequent year. So, as per the standard, any timing difference originated during the tax holiday period and reversing after the tax holiday period to be accounted, and whatever is reversed during the tax holiday to be ignored. So, accordingly, the reverse are 228 out of your 275 to be ignored, and only the balance amount will be considered for your DTA or DTL 47 lakhs, 275 minus 228. And second year onwards, everything is reversing in the subsequent year. So, we will be considering that. So, this is the example. Current tax is nil because your computation is nil. That as the first slide. So 47 is your 275 minus 246, on which 30% the tax is 14 lakhs. So liability you are creating because your depreciation as right is more, book is less, of which a portion is reversed within the tax holiday period that you are ignoring. Net amount 47, we are computing deferred liability of 14 lakhs. It's nothing but this figure. 275 minus 228, on which 30%. Next year is 181. 181 lakhs into 30% is 54. So 14 plus 54, 68 is your liability on the second year. So current year charge is 14 lakhs for first year, 54 for second year. Third year, 111 into 30, 33. Aggregate is 101, 33 is a charge. So like this, we are going till 5th, 6th, 7th, and 10th. There is no, because it's only reversal during the period. Already these things we factored in the very first note. So there is no impact. And 11th in order is regular computation. So your deferred tax will be coming down. Liability will come down, but your current tax will be on the 30% on your 900 rupees, 270. This is your basic computation. So now with this, first year you'll be accounting deferred tax liability of 14 lakhs, your current tax is 14 lakhs. Second year, you'll be accounting a deferred tax liability of 68 lakhs, of which your 54 lakhs is your current tax expense and crediting liability. Deferred tax liability. Though the current tax is 0, deferred tax is your 54 rupees. So 54 plus 14 is equal to 68. Third year it will be 33 plus 68 is 101, like that it will go up. And after 15th year, the 6 lakhs will be added as created as new asset. Hope this concept is clear. Any query at this stage, you can ask me, or I'll give one more example, post that also you can ask. Mr. Durga Prasad, the same financial year, there is a 43 decimal of 2 lakhs and carry forward of 3 lakhs. I will come to this specifically. This one interesting question. I will explain that in detail. The rate, oh no, 1 BPA means 30% will not come into picture. You will go by a lower tax rate. No, all these things will go for task. I will explain that also in detail, sir. Whether income tax provision to be created on book profits or tax as per income tax provision. Sir, if you are talking about MAT, that is your current tax. That I will explain in detail with a live example. That is the minimum tax you are going to pay if you are going to pay tax as book profit. But deferred tax always on your taxable rate, not as per book profit rate, because that is at I think it's now 15% from this last assessment year. So you'll be making payment to the government on book profit 15%. But for deferred tax purposes, unless you are going for this 150B, as other gentleman has asked, you have to create deferred tax at 30% because that will be reversed in subsequent period. At the time, you are not sure whether you're going to be under MAT tax or regular tax. Deferred tax asset you will be recognizing only if you are certain. That also I will explain what is the reason. There are 2 levels of certainty. For example, 43B disallowances and 43B disallowances or neither disallowances, you can go for a reasonable certainty. But if it's the case of losses, it has to be virtual certainty. I'll explain the difference between these two. Mr. Durga Prasad, this is your query. If I, after the subsequent slide, if you are still unanswered, you let me know. I'll again explain, but time being, I'm parking this query, sir.
Sir, I have a query.
Yeah, please.
Sir, in case a company is paying under the MAT provisioning, Okay.
Yes.
So now the 43B doesn't arise because the company is paying 18.5% under the MAT. Okay, in that case, whether I require to create the DTA.
Can you
on
repeat
the
your query, sir, once
43B.
again? You're under MAT.
Yes, sir. I'm paying under MAT.
Okay.
The under the normal provisional tax liability is less. So whether I require to create the DTA on the 43B payments.
Yeah, obviously you would require.
Because sir, I'm paying the tax on the MAT.
MAT, because but this 43 disallowance, MAT is nothing but your regular computation is lower than your book profit. That's why you're paying a tax as per book profit.
Yes.
But your regular computation is assuming that zero. For example, after this 43 disallowance also it's zero. But your MAT you are making payment. This MAT you are eligible to claim a MAT credit in subsequent year.
Sure.
So you're going to take a MAT credit entitlement.
Okay,
this is independent of your deferred tax asset because our liability whatever may be, because that is only for the timing adjustments. I'll show the reconciliation also, then you have a clarity. I'll show that sheet.
Okay. Thank you, sir.
So deferred tax assets, what is the conditions? So deferred tax assets should be recognized and carried forward only to the extent that they are reasonable certainty that sufficient future taxable income will be there to absorb these deferred assets. So this is the fundamental assumption. So deferred tax asset by principle to be recognized, should be recognized and carry forward only to the extent that there is a reasonable certainty. For example, deferred tax assets on your disallowances under 43B or 40IA, whatever may be, it can be accounted once we have reasonable certainty. While recognizing the tax effect and timing differences, consideration of prudence cannot be ignored. Hence, we are looking for a reasonable certainty. But when a company has another depreciation or carry forward losses, deferred tax assets should be recognized only to the extent there is a virtual certainty. There is a difference between these two words. One is reasonable certainty for other disallowances, but for when you come to carry forward losses depreciation, you have to see virtual certainty, because normally when a company is making losses, they will not be in position to absorb this deferred tax assets in the subsequent year unless they make profit. So we have to be extra cautious whether there is we have to check whether there is a virtual certainty. Standard explains what is the virtual certainty. We'll discuss. Determination of virtual certainty that sufficient future taxable income will be available is a matter of judgment based on convincing evidence and will have to be evaluated on a case-to-case basis. So we should not just like to say that this year I will carry forward losses, I am accounting deferred tax assets. It's not possible. By doing that, you are going to reduce the losses for the year. As we have deferred tax assets, that is not permitted in standard. We have to check whether there is a convincing evidence. So virtual certainty refers to the extent of certainty, which for all practical purposes can be considered certain. That is the most important thing. It is available on date. I am certain that I will make profit next year. So based on your projections of the management or future cash flows of the management or any project report submitted to the bank for the availment of loan, those are all not evidence to substantiate whether the company is making profit in subsequent years. For taking an item as a certain, you must have a concrete order. The company would have made a loss in the current year because of depreciation. Suppose the company is putting a new plant because of which they are eligible to claim a depreciation at a 40% at additional depreciation, etc. Because of which they would have made a loss in the tax return. But in books, they will be claiming depreciation over a period of 15 years. So it will have a profit. In that case, this loss is definitely available to the company. You can account it. But if the books also there is a loss, in tax also there is loss, and the company is having any tangible evidence to convince that they will be making any profit in subsequent year, then you can't recognize asset for the losses and depreciation without any virtual certainty. So virtual certainty is not a matter of perception, and it has to be supported by convincing evidence. So we need to be extra cautious whenever we are going to recognize any asset under deferred tax on account of depreciation or losses. Reassessment of deferred tax assets. Every balance sheet we need to check because suppose first year you are saying that there is no virtual certainty, we are not recognizing the deferred tax asset. It is shown outside the books. Every year we need to check whether there is any improvement, whether there is a change in the understanding or estimate. If it is so, there is a change, then we do need to recognize the asset. Otherwise, you have to defer that every year. So every year we have to check for the virtual certainty whenever there is a losses or depreciation. How to be measured? Current tax should be measured. One member has asked the query on this. Current tax should be measured at the amount expected to be paid or recovered from the taxation authority using the applicable tax rate and tax laws. Suppose the company has allotted for lower tax regime, then they will go under this. So current tax, if they are going under MAT, this is the current tax. So under the expected tax laws, whatever is your tax rate, that is the current tax. Deferred tax assets and liabilities should be measured using the tax rate and tax laws that have been enacted substantially enacted by the balance sheet date. Why they are using the word substantially enacted is, suppose you are going under MAT. For the current tax, you are taking 20% tax. Assume I'm not going to the number exactly, saying, for example, MAT tax is 20%, but regular tax is 30%. You will be accounting the book profit 20% as a current tax. When you come to deferred tax on the disallowances, 43B or whatever may be, you have to see what is the rate that is applicable for the next assessment year, because this assessment is over. From next assessment year, what is the tax rate? Suppose there is a concession in the tax rate. Instead of 30%, they are going to make it as 25%, or they are going to increase 35%. You have to account the deferred tax and liabilities at the rate applicable from the on the rate of the balance sheet or substantially enacted, because they would have passed the order act subject to the president approval. Normally, the president approval is only a formality, because once approved by the members in the parliament, it is only a formality. So then we have to check that. But if it is pending approval of the parliament, then it is not substantially enacted. Then we have to go with the act that is in force on the date. The explanation is the payment of tax under 115 JB is the current tax. As I told earlier, whatever is the computation under minimum tax is the current tax. When in the period when a company is making payment under 115 JB, the deferred tax and liabilities to be accounted at the regular tax rate and not at the rate under section 115 JB. This is a fundamental thing. Please don't forget, your computation under book profit is different. Computation under deferred tax and liability is different. Computation under deferred tax and liability is as per the computation of the IT laws and not for the purpose of your MAT payment. So don't mix these two things. Your because once you adjust these differences, you'll know what is the purpose I'm saying now. 150 JB tax is the minimum tax you're going to pay. But in addition to that, you have to account for deferred taxes and liabilities, based on which your total tax liability will be 30%. I'll explain that also. This is the one thing. Second thing is, when you come to 115 JB, this deferred tax assets or liabilities is going to be adjusted in subsequent years. At that point, you may be paying tax at the regular rate. So there is no purpose in accounting that at the MAT rate in the current year. Then your matching concept will not work. Similarly, whenever you expect the amount to be reversed in the subsequent year, there also you will be accounting at the regular rate and not at 115 JB. So these two concepts you keep in mind. Always your deferred tax computation will be at the tax rate and regular tax rate and not as per the MAT tax rate. Your regular tax rate can be 30% or this lower tax rate of 22.5 whatever may be at the new regime. And the deferred tax and liability should not be discounted at present value. It has to be always at actual value. There is no concept of discounting deferred tax assets and liabilities. Once you recognize the deferred tax asset, previously we discussed about unrecognized deferred tax asset, that is losses you have not recognized in the books. You have to reevaluate every year to check whether the loss to be accounted. Here, already recognized an asset. Even then, you have to review that carry forward amount every year to check whether it is correct to carry forward this asset, otherwise to be charged off. Whenever you are reversing based on uncertainty, subsequently you can restate it based on any improvement. So every balance sheet date, you have to check whether the deferred tax asset shown in the balance sheet is it can be carried forward or not. So let us come to the presentation disclosure. The enterprise should offset assets and liabilities representing current tax if the enterprise has a legally enforceable right to set off the recognized amount and intend to settle the assets and liabilities on a net basis. This concept is not really useful for Indian perspective because we are governed under a single tax law. Pan India, we are having single tax law, but certain European countries, they have different tax laws where they can adjust based on the agreement between the various countries. But here, normally, unless you are a very big conglomerate where like Infosys, where you are coming under different tax jurisdiction, this is not applicable. So we are talking about, and moreover, we are discussing only from a small company perspective. So we are handling about only the Indian income tax law. There is no question of this adjustment, sir. So enterprise should offset deferred tax asset liability if the enterprise has legally enforceable right. Same concept here. It is not relevant from the Indian perspective. Deferred tax and assets and liabilities should be distinguished from the assets and liabilities representing current tax for the period. So it should not be clubbed along with some other current asset. It has to be shown as a separate line item with the balance sheet separately from the current assets and current liabilities. It has to be a separate line item under your assets or liability. If it is asset, deferred tax assets to be shown as a separate line item under your current tax assets. Current assets. Similarly, for liability, under current liability, that's shown as a deferred tax liability has to be a separate line item. You can't add it to some other account to show as net amount. The nature of evidence supporting the recognition of deferred tax assets should be disclosed. Here, there will be most of the people will make a mistake. They will not disclose how this entity is certain about the assets will be recognized, realized, so that note has to be required. If enterprise has an unabsorbed depreciation or carry for loss under the tax law. If you are going to recognize deferred tax assets on unabsorbed depreciation or carry for loss, we have to give a note saying that how there is a convincing evidence that it can be recognized. This is one example. Book profit is 10 lakhs before depreciation. IT also before 10 lakhs. There is no difference. Depreciation as per books is 1 lakh, but IT is 22 lakhs. So there is a 1 lakh excess claim. So any claim over and above what is charged in the book is always liability. That is a thumb rule that you please understand. Any disallowance in the IT which is not factored in the books will be subsequently allowed for tax purposes. Is the deferred tax asset. This is the first thumb rule. So 43 disallowances. Only in IT, already that has been accounted in the books, but since you have not made the payment, that is disallowed for tax purposes, that is a deferred tax asset. Provision for doubtful debts, it is deferred tax asset because either you will realize that amount from the customer or you will be writing it off a bad debts. At the time, you will be claiming as reduction. So, provision for doubtful debts is not allowable reduction, but when you are writing off those debts in a subsequent year as a bad debt, then you can claim as reduction. So, it is deferred tax asset. Provision for gratuity, at the time of provision, it will be disallowed, but whenever you are making payment to a trust or to your employees, you can claim as reduction. So, whenever you are making a provision, you will be disallowing it, you will be claiming as deferred tax asset. And if you are going to make a payment, that is also a reduction from deferred tax asset. Interest on income tax, it is a permanent disallowance because it is a penal nature. It will not be allowed as for tax purposes. So, it will be added only the memo. Already the amount is charged of the P&L, so it is no implication as far as DT or DT is concerned. It is being a permanent disallowance. Penalty paid similarly, it is only for tax purposes. Already charged of in P&L, it is a permanent disallowance. Donations similarly already accounted in the books, but added for tax purposes, there is no benefit. So total profit as per book is 9 lakh, that is 10 lakh minus 1 lakh. But IT 10 lakhs minus 2 lakhs with all these additions, it is 11 lakh 25,000. Net difference is 2.25 lakhs. Half is 2.25 lakh. So deferred tax liability is 1 lakh. That is 1 lakh on depreciation. Deferred tax assets on these 4 items, that is 43B, doubtful debts, gratuity, etc. On which tax rate is 52,500. Permanent disallowance is 1,50,000 items. So the total disallowance has to be bifurcated into DTL, permanent differences. Tax rate is 30%, 52, net effect is 22. If you compute tax on your 9 lakhs at 30% is 2,70,000. On 11 lakh 25, 3 lakh 37,500. Difference is 60,500. Your book tax, if it computed 30% and your actual tax flow, difference is 60,500, of which you are going to recognize a DTA only at 22,500 as per this. Balance 45,000 is nothing but 30% on your permanent disallowance of 1,50,000. So you need to have a reconciliation like this so that it will be easy to ensure that there is no omission. So whenever you are going to recognize any DTA, check whether the company will have a profit in subsequent year to absorb this item. Otherwise, you have to ignore this. But for these type of 43 disallowance, obviously the company will be questioned because only for the limited purposes, it will be disallowed and subsequent year it will be claimed on payment basis. So you can recognize that. Suppose in the same example, one more thing I'm going to say, profit before depreciation 6 lakhs as a book and IT also 6 lakhs, of which you're going to make the claim. Book after depreciation is 7 lakh loss, IT it is minus 4.5 lakh. Pardon sir, I'm unable to hear you.
I think somebody is unmuted. I'll check it, sir.
Sir, please unmute yourselves and speak, sir.
Thank you. So in this case, the book loss is 7 lakh after depreciation. That is loss before your tax is 7 lakhs, on which the normal tax rate is 30%. Negative is 2.1 lakhs. As I said, the current tax is both plus and minus. This 2.1 lakhs I'm going to get from the government as future date whenever I'm going to make a profit. But tax purposes is only 1,42,500. The difference is same 67,500. The previous slide also we had 67,500. For simplicity, I'm retaining everything same except your losses. So tax number is 2,10,000, and for tax it is 1,42,500, difference 67,500, of which the DTA is 22,500. We'll be accounting on these items we discussed, and permanent difference is 45,000. Your 1,42,500 will be common for both. So for these purposes, you will be accounting your DTA at 22,500 in your books. Net amount that of your liability and assets is 22,500, and 1,42,500 your current tax, that is the current tax in your books, so that your tax will be equal to 30,000. But 2,10,000 minus your 45,000 will be a charge to the P&L. It will be represented. Hope I am clear in this, sir. You raised a query on DTA. If still you have any query, you can ask now, sir. With this example, I can clarify that also. The same financial year, there is a 43 disallowance of 2 lakhs and a carry forward loss of 3 lakhs. Please confirm DTA is to be calculated on which amount. Sir, these two things are independent. DTA is on the item by item. What are the disallowances? Whether it is a permanent or a temporary. If it is temporary, we will be recognizing DTA or DTL. That is independent. After doing all this adjustment, there is a loss which is eligible to carry forward, because these adjustments 4,75,000 is after doing all these adjustments. So this 4,75,000 is eligible to carry forward, on which the tax impact is 1,42,500, which the company is eligible to claim in the subsequent year. You recognize only that impact for 67,500, of which you accounted only 22,500, balance 45,000 is permanent. But balance 1,42,500, the company can claim the subsequent year. So this is this adjustment for this DTA or DTL. So these items are independent, then your carry forward losses are depreciation. Hope I'm clear, sir. But this 1,42,500 I can account only if I have a virtual certainty. But for this 22,500, I can account on reasonable certainty. So definitely we'll be sure that the company will be making income and to adjust this carryover. But this 1,42,000, unless the company is confident of making a profit in subsequent year by way of virtual certainty with concrete evidence, we can't recognize that. We have to defer this recognition till such time there is a tangible evidence that the company can make profit. So should the rate be 30%? I explained. It is once you are going for 150BA, current tax rate is a lower rate only. If you are going for MAT, your current tax rate is a MAT rate. So in case of small company, where till now the taxes have been provided as per the current taxes only, and now the company wants to follow AS20 position, whether the adjustments are. Yes, sir, you have to recompute your complete memo. See, checking whether what is the deferred tax assets eligible or deferred tax liability eligible. Deferred tax liability is very simple. You take your opening double DB as per books and opening double DB as per IT. IT, there will not be any land. Building your claim depreciation. If the company has any land, you exclude the land from your book double DB and compare that balance with your IT double DB. The difference between those two things is your deferred tax liability. Normally, it will be deferred tax liability unless the company is having a huge amount of computers. Otherwise, it will be deferred tax liability only. If your book double DB is more than IT double DB, it is always a liability. If your book double DB is less than IT double DB, it's an asset. That is a logic, because you have claimed more in tax purposes but claimed less in books. So these two things you have to compare and provide the liability. First thing. For other disallowances, based on your past memo, 2-3 years, if you see any disallowance made which are still to be claimed in your IT. But ECS provision for doubtful debts. From your trade receivable, you can see whether that amount is still there. Then that is opening balance. You have to take it as a deferred tax asset. Your provision for inventories, if anything is there, then you can claim that. Like that, you have to go through each and every balance sheet item to check whether correct the mistake. But this is a mistake. So you have to, at the best, you correct it, because there is no exception to provide only for the current tax and not for deferred tax. You have to account both these things as for AS22. This is not mandatory only from this year, it's mandatory for very long years. So make the corrections and comply with it. Is DTA is current asset or non-current? It seems neither current or non-current. It is always a current, because anything we will not classify as non-current. Only any refund from department, whenever we have doubt that will not release, we will be showing as non-current, but DTA is always a credit. I think PPT I will be sharing with the institute, they will be sharing to all the participants. I think I'm Thank you. Yeah, thank you. Any further query on this, or can I go to the next slide? One thing is, whenever you are preparing a finalizing accounts, have this statement with you. Have two columns: tax as per books, tax for IT, and do a line by line adjustments. Then you will identify whether that will be allowed or disallowed in subsequent year. If it is not, then it is a permanent disallowance. Ignore this. Or for all other items, you claim that. Thumb rule is whatever claimed more in IT is your liability. Whatever claimed less in IT is your asset. So always all disallowance are assets unless that is a permanent disallowance. All additional claims are a liability because you will be making payment in the subsequent year. So with this, I think Kishore Babu has raised hand. Please unmute, sir. Kishore Babu, sir, please clarify.
Yeah. Are you able to hear me, sir?
Yeah, very well.
Okay. See, when a company is not certain about making the profits in the future, then no DTA is recognized.
Yes.
For which a notice prepared as no DTA is recognized in the books as a measure of prudence. Is that the correct note, sir?
Yeah, due to lack of virtual certainty. If the deferred tax is on account of your carry forward, then you have to use the word virtual certainty. If it is on account of your other disallowances, 43, etc., if you are not going to recognize, then you have to mention that on account of reasonable certainty.
Okay.
These two things are different.
Okay, thank you.
But liability you have to account. If suppose there is a liability alone, then you have to definitely account. First, if liability is more, in the example what I have shown is asset is more.
Yeah.
In this case, you have to check whether there is a reasonable. For accounting, is 22,500. Suppose this is instead of 52,500 is only 2,500. 20,500 is your DTL. You have to compulsory account that. There is no option at all. DTL is compulsory.
Right.
So most of the companies, what they will do know, they will restrict that deferred tax asset to the extent of deferred tax liability. They will put a note accordingly.
Okay.
Hope I am clear.
Thank you, sir.
Yeah, welcome.
Yes.
Sorry. Any further queries, please? Yeah, I'll just go through the accounting on MAT. Now we discuss about your current tax and deferred tax. Current tax is, suppose your tax rate is 30%. Your the previous slide itself will go 9 lakhs, on which your 30% is 2.7 lakhs. But your IT profit is suppose example instead of 1 lakh, it is only 3 lakhs. Then you have to pay tax on book profit at 20%. So then only the MAT is coming to picture. Your outflow will be more. Suppose if there is no provision of 115 JB, then your outflow is final. There is no adjustment. But the government wants to give some concession. Whenever you are making a more profit under regular computation, you can claim this taxes paid as a MAT creditor. So to the extent where the increase is more and above your MAT, minimum payment is MAT. That you can't say that you will not pay less than amount in subsequent year. Wherever there is a regular computation more than the MAT payment, to the extent you can adjust. Previously, it was it can be carried forward for 7 years. Now it is up to 15 years. They are permitted to carry forward. There is a welcome change. How that MAT creditor can be accounted in the books of account, for which Institute has given a guidance note. I just walk you through to that to understand how this shall be complied with. As you are aware, Finance Act 97 was has introduced the section 115 JA for the first time to give tax credit in terms of MAT paid in 150 JA. Till then, until 97, there is no concept of any MAT, and hence there is no question of any MAT credit, etc. This 150 JA was enforced till March 2001. Subsequently, a new section has come 150 JB with the assessment date 2001-2. Now the tax rate is 15% under MAT. So irrespective of your taxable profit, you have to pay 50% of your book profit. There are no adjustment permitted now. Previously, there will be some adjustment now, except your carry forward losses as per books, no other adjustment is permitted. Literally, you have to pay 50% tax on your book profit. If your tax paid under 150 JB is more than the tax liability on regular computation, assessee can claim tax credit. Suppose as per regular computation, the tax liability is 0. Under MAT, it is 2 lakhs. You can claim 2 lakhs as your MAT credit. the MAT credit will be equal to the excess of MAT over nominal income tax. As I said, 2 lakhs minus 0, 2 lakhs is your MAT credit. That is the maximum. Suppose your tax computation is 1 lakh and MAT is 2 lakh. 1 lakh is the amount you can carry forward, not more than that. The MAT credit is treated as a prepaid taxes, just like your advance tax or TDS. It will be treated as a prepaid tax, and it will be adjusted in the subsequent year when your regular computation exceeds your MAT computation. So obviously, somebody has claimed interest. Now government has amended section. There is no interest on this payments on MAT credit. So MAT credit can be carried forward, set off for a period of 15 years. Originally, it was 7 years till 10-11, then raised to 10 years. Now it has to be permitted to be carried for 15 years. However, in case of conversion of a private company or an unlisted public company into LLP, the benefit of MAT credit is not eligible in the hands of the successor LLP. So you have to be careful whenever you are doing a restructuring. Ensure that you utilize all your MAT credit completely. Otherwise, you will be losing that. Similarly, when you are accessing your 115 BAA, any unutilized MAT credit is lost. So before opting for this lower rate of tax, ensure that you claim the fully your carry forward losses or your MAT credit. Otherwise, this will be lost permanently because you can defer the period, because this will be more beneficial to claim this MAT credit instead of opting for 115 BAA. So you have to refer the guidance note. It's only 4-5 pages guidance note issued by Institute of Chartered of India on MAT credit. So that is very useful how to understand this concept and how to be accounted with. Let us go through the accounting treatment in detail. Whether MAT credit is a deferred tax asset within the meaning of AS 22. This is the first query raised. They analyze that. So it is not a deferred tax asset, because deferred tax asset or deferred tax liability will be accounted only based on the timing difference. This MAT credit is not a timing difference. This is a concession given by the government by way of a section. You are asked to pay a tax on a particular amount on a notional basis. Subsequently, whenever you are making a profit, you can adjust that. That's a concession given. So it is not a deferred tax asset or for the purpose of AS 22. So it is something different. Whether it can be recognized as an asset. Yes, it can be recognized as an asset, provided the company is confident that they will be making profit on regular computation and will be utilizing them. So suppose the company is making losses every year and paying a book profit tax, and they are not sure whether they will be adjusting this amount in subsequent year. Definitely, they should not recognize that. This is based on any other, like any other asset. You have to test whether that asset will be recoverable in the subsequent years. If you are sure, you can recognize this. Otherwise, you are not supposed to recognize this. So when MAT credit is recognized as an asset, the same should be reviewed at each balance sheet date. A company should write down the carrying amount of MAT to the extent it is no longer a convincing evidence to the effect that the company will pay a normal income tax within the same period. Otherwise, they can continuing that amount. For example, with the current year DTL, because IT depreciation more than book depreciation, but from next year on, the book depreciation will be more than IT depreciation, which will result in the difference of DTL, and thus the company is liable to pay income and normal tax. So normally, whenever a company is started, the depreciation claim will be huge, but in the subsequent year, the depreciation as IT will come down, but book the profit will go up. Obviously, they will be paying tax on regular tax. Then they will be in a position to adjust this MAT credit. They can recognize this account in the books. So, how this is shown in the balance sheet. MAT credit is present under the head loans and advances as a separate line item. It has been shown as a MAT credit entitlement. In the era of set off of credit, suppose in the 1 year when the regular computation is more than the MAT liability, the amount to the extent is set off, it has been shown as reduction from provisional taxation. Normally, we will be showing the advance tax as a tax payment pending adjustment and the provisional taxation full amount as a liability. But whenever you are adjusting MAT liability, you have to move that asset to the liability and show the net amount as the liability in the balance sheet. The unavailed MAT credit, if any, should continue to present as head and also should continue to be the concession of recognition. So this is the one thing. Every year we have to review the MAT credit, whether it is less than the 15 years. That first thing you have to check. If it is already 15 years expired, we have to remove that from the asset and charge it to P&L. If it is less than 15 years, you have to check whether that is eligible to be adjusted in subsequent year. If so, then you can continue. Otherwise, you have to charge that. Like any other asset, we have to test this for impairment on a yearly basis. How this is shown in the P&L. Institute has given a clarification as accounting and interpretation 6, clarifying that MAT is a current tax. That is the first thing. So whenever you are making payment of tax under MAT, you show group under the current tax. Accordingly, the tax person on MAT it should be charged P&L as current tax. but you are eligible to claim this as a refund, either full amount or to the extent difference between your MAT tax and regular tax in the subsequent year. To the extent you can deduct that amount as a credit in the P&L, MAT credit entitlement, and you will be accounting deferred tax based on the discussion we had in the preceding slides that you had account. All these three put together is the total tax expense. So assuming that 1 lakh is your current tax under MAT, of which you are eligible to claim 50,000 as a MAT credit entitlement. So 1 lakh minus 50,000, deferred tax assuming 22,500. So 50 plus 22,500, 72,500 is your total tax expense for the year. Normally, once you calculate this, this rate will be equal to 30% other than the permanent disallowance. So profit as per P&L, add your permanent disallowances, then compute the tax rate. This will match normally. One example, based on the previous thing what we discussed for your deferred tax, same example I have taken for simplicity. Income before depreciation is 1,000 rupees, 1,000 lakhs per annum. After depreciation 900. As per tax law 625. Deduction under ATA, IA is 625. Taxable income nil for 10 years, and subsequently it is taxable income reserve. Tax expenses 14 that we have seen in the previous slide how it is calculated. So I am taking the same rate. From 11th year onwards, there is no ATA. So on 900 lakhs is 30% is 270 lakhs. So it will come constant. MAT tax assuming 50%. So 135 on this 900. This is the minimum amount payable. So though as for regular computation you are able to pay only 14 lakhs, under MAT tax you have to pay 135 lakhs. Whichever is here to liability, 135 you will be paying. So difference between 135 and regular tax 121 is a MAT credit, and you can carry it forward till such time you are adjusting subsequent year or 15 years, whichever is lower. So every year you will be carrying forward this amount 121, 81, 102, 118, 129. Subsequently, it is 135 common because there is no tax liability for the next 5 years. And suppose that you will be paying under regular tax 270 is the payment, whereas your MAT tax is only 125. So you are eligible to claim 135, provided there is a carryover. Here on year 10, you have 1226 is the carryover MAT credit of which you are claiming that. So first year it is not lapsed, second year is not lapsed, third year is not lapsed. You have to check every year, and this statement you have to update on a yearly basis because this is notional amount prepared based on the first year assumption. Subsequently, on actuals on second year, the figures may undergo change. Based on that, you have to correct this on a yearly basis and check whether the MAT credit or your deferred tax asset or liability, whatever may be, is correctly shown based on the current estimates, not on the wrong estimates. So this is the way how we are going to account the deferred tax assets, deferred tax liability and MAT on any transaction in the P&L. Hope I am clear. Any queries, please? MAT credit is a there is no question of optional there because it's eligibility. But if you are not certain about recognizing that thing, you are not supposed to account that because we are going to account an asset. Otherwise, you can account because your profit will show a better figure. Any queries, please?
Sir, John Matthew has posted a query in the chat box, but I think it's not complete. In profit and loss account presentation shown, current tax is. So I think we want a clarity on the question.
Yeah.
Yes,
We'll wait for his completion. Otherwise, he can unmute and ask.
Yeah, the participants can unmute and ask. You are given the permission. Please, you can do that. The problem is if we unmute all, who will get private talks. So I have muted all again. So you can unmute yourself, sir. We have a question in the chat box.
Yeah. MAT credit can be availed to the extent of MAT in the year in which normal tax is higher than MAT. Yes. In the year 1, your MAT tax is 100, current tax is 0. So you are eligible to carry for 100. Subsequent year, your MAT tax is 100, your regular tax is 150. To the extent of 50, you can claim. Balance 50 will be carried over. It will be adjusted in the year when you are having that excess over and above the MAT tax. And subject to 15 years limit. 15 years is a very long period. Previously, it was only 7 years. At the time, most of the people lost. 10 years is a good amount. I don't think any company can carry over MAT credit for more than 10 years. Otherwise, the company is running in a difficult position. 15 years is a very good thing. Thank you, Mr. Subramaniam. I will just go through the comments of a review board, QRB as well as FRRB on AS22. Working papers were not available for current tax and deferred tax liabilities as the financials. See, we will be closing the financials during audit, but subsequently while doing a filing return, there will be some changes in the tax memo. That is different, but books is different, tax is different. Books tax liability we will computing when we are signing the accounts. It has no relevance for your tax filing. So on the date of your preparation of financial statement, whatever workings you have for your current tax or deferred tax, it must be duly documented, and any justifications or explanations to be documented in the accounts file itself, and it must be readily available for verification at any point of time. In most of the cases, they will not have any workings for this computation of current tax and deferred tax, which has been taken seriously by the regulators. Conclusion regarding reasonable certainty for deferred tax assets is not maintained. This is one of the most important things. See, reasonable certainty is one of the things. For your carry forward losses depreciation, you have to check the virtual certainty. We must document how the company is confident of recovering the asset recognized in the books. So we need to have a proper documentation to substantiate that. This need not be disclosed fully in the published accounts, but we have to mention the fact that the company has evidence to recognize this asset. Value of land is also considered as WDV. I told you, when you are comparing your ITWDV, book WDV, some cases they have adjusted this also and computed the deferred tax amount or net amount. That is totally wrong, because the WDV as per on land has no relevance for IT. IT is not giving depreciation on land. So you have to exclude the land from the book WDV and compare that amount with the ITWDV. Or if you are going on a year-on-year basis, the depreciation of books and depreciation as per IT, then it will be easy to correlate. Incomplete disclosure had been made in respect of deferred assets and deferred liabilities as specified in para 31. See, whenever you are going disclosure of deferred assets and liability, you have to tell clearly what is the nature. Example, differences between IT depreciation, book depreciation, deferred as liability amount you have to mention. Disallowance and income tax as allowable in subsequent year, you have to mention that. Provision for employee benefit disallowed and claimed in subsequent year, you have to mention that. You have to mention the major heads. You need not give 25 line item. At least you have to categorize that into 3 or 4 major heads and show clearly to classify what is the component of the deferred assets or liabilities so that the readers can understand clearly. This is the requirement of the standard. But in most of the cases, they will just put a figure deferred asset or deferred as liability without giving indication. That is not correct. That is not sufficient also for the readers to understand. The entity classified MAT credit entitlement advance tax treated as short-term loans and advances, but as the guidance note, that will be classified as a long-term loans and advances. That is only a classification change. See, till such time the refund is determined, you have to show it as a long term, because we are not sure when the amount the department is going to give the refund. But if the refund is determined and subsequently you are sure that it will be recorded in 1 year, you can show as current assets or liability. Otherwise, it is always a long-term assets or liability. Deferred tax asset was clubbed under non-current asset instead of being separately disclosed in the face of the balance sheet. Yes, the Schedule 3 is giving a separate line item for the deferred tax assets and liability. You have to comply with that. For example, for other companies, Schedule 3. Under non-current assets, after finance, non-current assets, after your property, plant and equipment, intangible asset, capital work in progress, intangible assets and development, non-current investment, deferred assets net. So this is the way you have to disclose. Similarly, for liabilities, non-current liabilities, there is a separate line item, deferred as liabilities net. You have to show it separately, but most of the few cases, no, they are grouping in other liabilities or other assets. That is not correct, though it is shown as a non-current. Ensure that that is disclosed separately and we give details line wise at least broad level. Instead of though you need not go to the micro level, at least at broad level, you have to give the details. MAT credit available to the company as per income tax return was inconsistent with the shown in the financial statement. This happens only for the current year. We can justify, not for the year. For example, when you are preparing the balance sheet, based on the details available on the date of balance sheet, you will be computing the book computation and the income tax computation. But while filing return, there may be some changes because of additional disallowances or additional claims. You would have disallowed certain things in the book tax computation, but while filing return, those payments would have been made or some other disallowances would have cropped up. So there will be a change between the taxable income as per the statement prepared for books as per the statement prepared for filing. So when you are doing the audit for the next year, you have to correct this. You can't carry it over. Every year you have to compare your tax memo of the previous year while finalizing the current year statement. Any difference in your MAT credit as per your balance sheet and what is the tax records to be adjusted correctly. But some cases, no, they will do it parallelly without linking it in a proper way, resulting in this command. An asset has been created by a company on account of inventory valuation, timing difference as 150A, 140BA. The deferred liability was created on differences in increase in sale tax, etc. However, the valuation of both opening and closing stock has been done in accordance with 140A. As told, there is no income should have been offered on account of different valuation. These type of adjustments automatically we have to take care. There is no question of any deferred asset or liability because we are following 140BA AS2 for book itself. There is no question of any deferred asset or liability as far as this is concerned. But only cases where there can be deferred asset or liability can come for inventory is if you are going to make a provision which is disallowed for tax purposes and will be claimed only on the settlement or realization, then we have to account it. So enhance substantially at the balance sheet date. So we need to be careful because suppose the act has been amended, the rate of tax has been reduced or increased, which is we are informed on the rate of balance sheet, then we have to take that rate for the purpose of computation of deferred asset liability. In some cases, it's not been done. That has been commented upon. Disclosure requirements are not complied with. That is one of the major query. I have done a lot of reviews, not only for small companies, even for larger listed companies. These disclosures are not complied with. That is being taken care seriously by the regulators. Regulation of deferred assets, despite of the fact that there are no record of virtual certainty that sufficient future tax will be available against which deferred tax has been realized. So we have to ensure whether there is a documentary evidence to substantiate that there is a virtual certainty that the deferred asset can be recognized. Otherwise, please defer it and give a proper note of disclosure. We are failure to review the carrying amount of deferred assets each balance sheet date. It has to be done, and we must review and document it properly so that future years review can be helpful and we are showing the correct amount in the assets. Failure to take deferred as effect in respect of depreciation charge in the retained earnings. This one mistake I want to highlight. Certain things now we will do some adjustments, whether it's permitted or not in the standard, I'm not going to that. Certain adjustments for earlier years will be directly routed through your opening reserves. Certain cases it will be permitted to regulators also whenever you are going to change a policy or anything. There are certain permissions to directly adjust on reserves. But while computing deferred tax liabilities, they are looking only from the P&L and not the adjustment made in the balance sheet. It just to be corrected. Otherwise, your statement is wrong. Whatever directly routed through your balance sheet also to be accounted. Not setting up provision for tax and advances tax when the company has legally enforceable right. See, you have to set off against provision for tax and advances because only the net amount is payable. Even for the current year, if you are going to make a provision for taxation of 1 lakh, advance tax and TDS is determined and paid by you. That will be adjusted against your provision for tax and net amount is payable. So it is correct to show only the net amount as your tax liability instead of showing us two heads. So that comment adjustment can be shown and balance sheet can be shown a true and fair view. Error in accounting policy is just one of the common observation. So that you need to have a proper policy regarding this deferred tax assets also, so to avoid any comment from the regulators. Can we set up? I think this explained, no tax liability as per Income Tax Act, but tax liability as per MAT. Kindly explain this example. See, suppose, for example, your profit after depreciation is 1 lakh for both things. But in IT, you are claiming depreciation, additional depreciation, because of the 1 lakh will become 0. But for MAT, you have to pay tax on 1 lakh as per book profit at 20% whatever may be. So that is the MAT liability. But IT, due to additional depreciation or some other benefit, you will not be paying tax. If, for example, tax holidays or ATA, there will not be tax liability. Definitely, there will not be any tax outgo under regular computation. So there are chances. Mr. Magesh, hope I'm clear. If you have any clarification, I can show the examples.
Sir, Ajit Kumar ji was asking that whether any dispute in virtual certainty should be qualified in the audit report.
No, virtual certainty, if there is a dispute, then they should not recognize the DTA. If the company wants to account the deferred as asset, irrespective of lack of evidence, definitely it has to be qualified. No tax liability as per income tax, tax liability is okay. In presentation of P&L account slide, whether current tax will be equal to MAT credit entitlement. Yes, if you are paying tax under MAT tax, current tax will be MAT liability, not credit entitlement. If your MAT may be 1 lakh, of which your credit may be 50,000 only. So current tax will be 1 lakh. I shown that in my slide also. Current tax is 1 lakh, then MAT credit entitlement 50,000 in bracket, then you defer tax. So all these three put together is your tax exemption for the year. John Matthew sir, hope I'm clear. Mr. Magesh has asked the query, can we set off carry forward loss while calculating tax as per income tax liability? After considering the above, no tax liability as per income tax. Tax liability as per MAT, kindly explain example. Yes, due to the carry forward losses, there is no tax liability. But under MAT, you can adjust only the lower of your book loss and book depreciation, whichever is lower. So, in the suppose if there is no loss in your books, then you will be paying tax under MAT as a minimum tax. It can happen. Yes. Whether any dispute virtual, I think I answered. Yes. You have to convince the client not to account the asset without any certainty. Definitely, if the company is adamant they want to show low loss by accounting the deferred asset which is not eligible, then definitely you have to qualify. Whether provision for tax can be net off with advance tax paid or whether it should be shown, it can be net off, sir. Return filing is only in your hand. See, you quantify the tax liability for the year, against which you have paid some payments to the government. So only the net amount is payable. If to show liability and asset separately, that asset has to come separately, liability has to paid separately. This is not the case. This has to be adjusted. Only the net amount is payable to the government. This may increase or reduce. This is based on the estimate as on 31st March. This can increase based on the developments from the date of your signing of balance sheet to the date of filing return. Any additional liability you would account in the subsequent year. Any lower reduction you will be writing back in the subsequent year. But this advance tax has to be adjusted in provision. Suppose you have paid advance tax of 10 lakh, the provision tax is only 3 lakh. You have to adjust this provision against the advance tax, show net 7 lakhs as a record from the government as tax payment pending adjustment or refund due. It can't be shown as a gross amount. Any further questions, please?
I think we have exhausted with the queries, sir. You have answered all the queries.
Yeah, I'll show one more slide for this cash flow statement, how the workings can be prepared. It will be easy for them to understand. I'll just see where that it is.
Also, participants are requesting you to share the PPT.
Yeah, definitely I'll do that. I'll send it to Madam.
Yes, sir. We will share with them. And Naresh ji wants the
I've updated in the PPT itself and a share, sir. I updated only just before this meeting, so I couldn't put in a PPT. I added it, but it was very clumsy, so that's why I showed the word file. I'll put in PPT and send it across. Are you able to see my Excel file?
Sir, please, yeah, that's fine.
Sir, whenever you're preparing a cash flow for a smaller entity, I'm talking about, not for larger entities where it will be difficult to, the company will have people to do all these things. But for when we are doing an audit of a smaller entity, just do a reconciliation of all the line items in your, I'll just. You're able to see the movement, isn't it?
Yes, sir. Yes.
Thank you. So each and every item in the balance sheet, you just put a variance. What is the difference between the current year and last year? This is the first step you have to do when you are doing a cash flow. So in this company, I have taken a small company where they have a share capital, reserve surplus. I have not taken into complicated adjustments so that to avoid confusion. Long-term borrowings they have trade payables, other current liabilities, and assets they have property, then inventories, trade receivables, cash and cash equivalents. Short-term cash, long-term loans or other current assets. This is the balance sheet total. It agrees with the liability. And this cash and cash colored separately. 83 lakhs was opening cash and cash equivalents. It's come up to 91.94. Difference is 8.65. I'll just go through the cash flow. 8.65 is the final figure for me. This is the figure. I'll increase the size also. 8.65 is the number. We will be doing the reconciliation. It consists of your operating cash flow, your investing cash flow, and your financing cash flow. The net increase is 8.65. Opening balance is 83 and closing balance is 91. Then you have to give a note referring to your working schedule, how this come. How we and similarly come to P&L. Your operation income is 38 crores, your other income is 19 crores, then your material is 30 crores, like that, all put together. Profit before tax is 40 lakhs. And your tax liability is current tax deferred tax is 16 lakhs and the net profit is 23 lakhs. This is the profit after tax. Now we'll come to notes is nothing but our working to find out what is the movement, to understand what are the changes happening. For example, plant and machinery, what is the opening balance, addition, deletions, closing balance, like that. And the long-term borrowings, how we are grouped under current and long-term. This is our internal. Every company will be having working for this. Without this, we can't find it account. In your other income, there is interest income, there is a profit on sale of assets, freight recoveries, liability is no longer required. So liability is no longer required. Return back is nothing but your creditors you are not paid, you are taken to P&L. So there is no cash movement. For interest income, we have discussed already that this has to be treated as your income from investment, not as your operating income. Profit on sale also you have to add it back and you have to show as a sale proceeds from fixed assets as your income from investments. Other expenses you have to go through each and every item. Rent is a normal payment, rates and taxes, fuel, insurance, bad debts. Bad debts is one adjustments, audit fees, profit fees, communication, etc. You have to check everything. Then we will go to the cash flow statement. You are starting from the profit before tax. You are adding depreciation because this is not a cash flow cash item. Interest expense as P&L will be added because we will be claiming as a interest expenses as a payment net of your debit is 65 lakhs as per P&L, 65 lakhs, 65,000, whereas your claim is 6364 because in the cash flow working there is one opening and closing interest due. We go to that balance sheet. So total interest expense as a P&L is 65 lakh, of which MSME credit is 17 not paid. Movement interest accrued but not is 152. Net interest paid to the 6364. Only this major observation by the regulator is they are not mapping it. They are just adding the same figure as debit to P&L, though there are certain movements. Profit and sale of assets to be adjusted here because we will be showing sale proceeds of fixed assets. We go to the sale proceeds of fixed assets. There will be what is the gross box sold, what is the accumulated depreciation on the assets sold, WDV, and what is the profit on sale of assets. This is the total sale value. So we can cross check that has to be disclosed. Then we'll come to bad debts. because bad debt is not a cash flow item. So we have to add that. Then while we showing the increase or decrease in debtors, we have to adjust that. Liability is no longer returned back. It is a creditors amount not paid. So it is not a cash flow item. We have to add or deduct and accordingly consider that as a creditors item. I will show you. Interest income. Similarly, as the expenditure, we have to add or deduct this interest income and do the adjustment for opening and closing interest accrued and offer that amount. As in this case, there is no change. There is no change. Otherwise, we have to do that adjustment. For example, if we come to inventories, I'm going to the everything is linked to balance sheet only. So what is the opening balance? What is the closing balance? Increase in asset is always outflow. Any increase in liability is inflow. Decrease in asset is inflow. Decrease in liability is outflow. That is the thumb rule for cash flow. You have this as a benchmark. Accordingly, it will be easy for you to do the reconciliation without any much difficulty. And whenever you complete one line item, you complete a zero. So for example, this debtors 2.23 is the net increase. From your workings, we are talking about opening balance 263, but you are dissolving this 853, 850 bad debts, balance at then 650, net decrease is 2.15 crores as against the balance movement of 2.23 crores. Difference these two is nothing but your bad debts written off. So like that, each and every line item, you can do the reconciliation. So there will not be any mistake. So receivables, there is a increase, decrease, that is a cash flow. Inventories, there is the outflow. Short term, there is inflow. Like that, you do and arrive at income tax. And then after that is the operating cash flow. The company has generated 1.82 plus as a cash flow from operating activities. From investing, they have purchased fixed assets to the tune of 19 lakh. They sold fixed assets for 3,50,000. Interest is received is 9.71 out of the investment made in the preceding year. There is no investment in the current year, but there is an income out of the investment made or deposit made in the preceding year that is shown as an investing activity. So total inflow or outflow from investing activity is 6.27 outflow. So the operating, they have made 1.82 income inflow. Operating investing, they made outflow of 6.27. Coming to finance activity, they paid interest on the borrowing received during the earlier year, 63 lakh, and they made a repayment of 1.13 crores out of borrowing made in the earlier year, 1.13, and they received a loan of 10 lakh during the year. So net outflow on account of finance activity is 1.67. 1.82 is the net inflow from operating activities, of which 6,20,000 is paid for investing purposes and 1.61 crores is paid for your financing purposes. Net increase or decrease is 8.65 is increased. Our opening cash and cash is 83 lakhs and closing is 91 lakhs. So this way you have to do reconciliation and you have to map it with the account. For each and every line item, you have working like this. This is what they are exercising, because we'll do some plus or minus in Excel. Sometimes there may be mistake. It may tally also some cases without a proper reconciliation. You have working for all the adjustment and cross check that with your net to this increase or decrease. And finally, it has to be zero, because adjustment of these all these things will have to be zero, because it's only a plus one net and minus another net. And have a grouping schedule for all the items in the balance sheet so that there will not be any mistake. This is most important, because I have seen most of the cases they will do the plus minus directly in this cash flow statement itself. That is not the right way to do. You have working for each and every line item like this, and you proceed further, so that it will be easy for you to explain whenever there is a query also. March interest and CG debit to account unpaid in April, impact on cash flow. Yes, that has to be treated as an unpaid. So whatever debited in the P&L, reduce that March interest and show as the interest paid as your financing activity for the purpose of cash flow. This will be shown as a payment in the subsequent year. Yeah. Illustrative cash flow statement is a raw one. If you want, I can share the Excel sheet. If it is of use of anybody, definitely I will not issue. But this is prepared in a crude form. You prepare in a detailed manner so that it will be easy for you to explain. Actually, this sheet has to be a part of your balance sheet itself, financial statement itself. Sure, I'll do this, sir. Yeah, not issue. Yeah, I'll show you that in a second. In this case, I taken a simple one, but normally cash and cash equivalent is nothing but cash balance. Your deposit maturing within a period of 3 months. Your current account balance. Only these things will be treated as a cash and cash equivalent, unless you have any investment preference shares which are redeemable within a period of 3 months when you are making investment. Now only that's not going to happen. So don't group investments under cash and cash equivalents for a safer side, because very difficult to justify that is a cash and cash equivalent. Go with only the bank balance, cash and bank balance. The two less than maturing within a period of 3 months.
Sir, fixed deposits maturing within 1 year, sir.
Yeah, that way you can see that is part of your cash equivalents. More than 1 year, it has to be total your non-cash. And moreover, you have to see only the original maturity date. You should not see from the balance sheet date. You are making a deposit on 1st of April for a period of 1 year. It is maturing on 1st of April 2022. That is not a short term. It is a long term. And for cash flow, cash and cash equivalents, only 3 months is the period mentioned. So any fixed deposits are made with the original maturity of more than 3 months, you always group it under non-cash equivalents and group it under investing activity, not as a your cash and cash equivalents activity.
March interest on cash credit debited in our account and paid in April.
Yeah, I already explained, sir. That is not a cash flow. It has to be adjusted as a non-cash flow.
Right.
Whether interest with employees for expenditure can be regarded as no, sir. It's advance, employee advance. It should not be grouped under cash itself.
So participants, if you have any more queries, we request you to type in the chat box, or you can very well send it to the branch so that we'll be forwarding to sir. And once we get a reply, we'll forward it to you. The PPT, once we receive from the speaker, we will definitely mail it to you and also post it in the WhatsApp group, which has been created for this refresher course. So I think we are done with the queries, sir. And we thank you very much for your patient explanation. Actually, you were not given one topic, but you were given a bouquet of topics. First, you have explained cash flow, thereafter deferred tax, thereafter MAT. You have done it very comprehensively with the examples also.
Thank you. Thank you.
So we will be looking forward to associate with you in the future also.
Yeah, please, sir. Pleasure to meet you all.
So thank you very much, sir. Before we conclude, I would give you a reminder of tomorrow's session. It will be on insight into the practical issues on Schedule 2 and Schedule 3, including illustrative formats and a brief on Nidhi companies. The speaker of the session will be C.A. Chinnasamy Ganeshan. We will be commencing our session exactly at 5 p.m. I request all of you to join the session tomorrow 5 p.m. But for now, thank you one and all. Thank you. Yes, sir, please.
So one query has come, whether this cash flow is applicable for consolidation. Yes, it is a must. Consolidation also includes cash flow.
This showcases your interest in resolving the issues. Thank you. Thank you.
No, only when we do a case on a practical basis, the queries can crop up. So
yes, sir. Yes, sir.
Each and every company, when we do a finalization, there some issues will crop up. That will be learning. So it is learning is always it is a continuing process.
Yes, sir. It was very much an interactive session.
Thank you.
And a very lively one also, sir.
Thank you, sir. Thanks for the support. Looking forward for more such meetings with you people. Thank you.
Thank you. Thank you very much, sir.
Thank you,
Good night, all of you. We'll sign off and meet at 5 p.m. tomorrow. Thank you.